view the recordings from there, right? Today I will try by evening if I am feeling well. Okay, after your class, I have class after this also, right at 1:30. So 1:30 to 3 again I have a class. So I'd rather what? Tell me after 3 p.m. if I get time, I'll tell the team or today only if possible we'll put it up. Okay, and about that solving class, if we get 10, 15, minimum 15 students, then makes point to do the solving class. Or else you already have the Excel sheets with you. I have given the Excel sheets. In that, if you have doubts, you can send me on WhatsApp. That is also not a very big problem. Okay. Today, what we'll do for section B questions, right? Those who are with me know that you must have seen those forex questions, right? In section B that come up, those are theory questions. I have given those notes, forex notes that are there, right? I'll give you those notes today. I bet minimum 2 to 3 MCQs, right, come from there only. Okay, so kindly take care of that. Okay, so can we start? Quickly, let's start. Okay, quickly. So simple in Baumal model, logic is very simple. I'll tell you. Either there can be, see, not a lot of analysis is done on Baumal model because no one takes Baumal model so seriously. But if the examiner wants to test you, he will test you how. Either you have extra cash or either you have shortage of cash. If you have extra cash, you will do investment. If you have what shortage of cash, then already whatever investment you have done, you will take back the investment, correct? So you will sell the investment. That is how things. So optimum level of what investment to be done or investment to be sold is to be found out in what Bauman. The formula is very similar, right? Where your annual holding cost is annual holding cost here only, or it is nothing but the opportunity cost of what? Tell me, holding cash, right? So how much to invest every time? That is one question that is there, right? Then that is one thing, and annual ordering cost becomes annual transaction cost, correct? So take care of that, right? You can find out number of transaction as well. I have given the formula, I think here Baumer model ka how to find out number of transactions and all that. Here. See, instead of remembering Baumol model, remember optimum amount of investment to be done or to be sold to minimize the total annual holding cost and annual transaction cost. This is what the basic logic of Baumol model is. And number of transactions, so you have done number of transaction or number of orders there also. Same logic here, correct? Annual extra cash or annual shortage of cash divided by amount to be invested or amount of investment to be sold. So let's quickly go. Company A, extra cash. After this, we have what? Your we have your Miller-Orr model. What is the Miller-Orr model all about? Tell me. Miller-Orr model is quite simple and straightforward. What is Miller-Orr model? See, you have a upper limit of cash, you have a lower limit of cash, and you have a what? See, you keep generally what minimum 1,000 I will keep with me, and maximum 5,000 I will keep in my wallet. Correct? Minimum 1,000, maximum 5,000. Correct? So the spread between 4,000, right? So Miller-Orr model tries to give you the spread, correct? Based on your old transactions, old amount of transactions, correct? So Miller-Orr model, right? Will you will be given the lower level by the Miller-Orr model. You have to find out the spread, correct? After finding out the spread, you will be able to find nothing but the return point of that on an average how much balance you want to keep. So spread is equal to 3 into bracket 3 by 4 into transaction cost per transaction into variance of cash flow divided by interest cost per day. Remember, there are variation of questions that are asked on interest cost per day. It is opportunity cost that is lost, right? Interest cost per day. It will be cost of borrowing. See, there is one question. I would have taken the question as well. The variance of cash flow, I think Miller suggests that whenever the balance reaches upper level, correct, do investment and bring cash to. So, what does the Miller model say? Extremes, if they are touching, correct? If it goes up or goes down, correct, it has to come to return point, right? Now, how to do this in Excel or calculator environment? This is a bit difficult to do in your normal calculator, right? I would recommend do this in what? Tell me. Always try to do this on which calculator? Scientific calculator this will work, but on normal calculator this does not work. Normal calculator when this problem is always going to be there, you will not be able to take out spread in normal calculator, right? Then variance is equal to standard deviation square, right? This also has come up a lot of times. Your return point is nothing but the lower level, one third of what spread, correct? Then at the end, when lower level you sell the investment, something this type of comes up 7.2% per annum, right? And assume there are 360 days. So it says interest cost per day. So you will have to do 7.2% or 0.072 divided by 360. This is one type of question that comes up. Even a question comes up where you have to find the difference. It will give you cost of borrowing and cost of depositing. You have to take the difference because it is opportunity cost, correct? So you have to take difference per day difference, that is come up in a lot of exams, can come up in your exam, correct? Remember, when it says 7.2% per annum, right, you have to divide by 360. You have to divide 0.072 by 360. You will get a very big answer, 0.0002, right? Always change it to number, correct? This is your Miller or model, correct? Then you have nothing but the cash forecast or cash budgeting question, right? Recently, this question has not been touched by the examiner, right? But small variations of these questions that I've taken up in class, right? Like to find sales, to find what cash received, cash paid, all the stuff. Small things might just appear. There, this question is quite similar to your MA question that is there. MA. MA and the same kind of questions are there, right? Have a look. Company A has following sales and details, right? So in this, what will happen? You have to what opening balance will be given to you of cash, correct? 2 or 3 months ka calculation you have to do, right? So there is no question in your book, but I have given one question to you, right? This is a question that I generally give. The question go Baba. This is the question that I generally give in class, right? 2, 3 formulas that we need to revise. Have a look. Sale is equal to what? Production. But if opening and closing stock was given and sale was given, in that case, what would happen? Opening stock plus production minus sales will give you closing stock. So if I have to find production units, how will the formula be rearranged? Tell me. Closing stock plus sales minus opening stock will give you what? Production of units. Makes sense? Have a look. Then we also had what? If purchase units are to be found out. Then you have opening stock of raw material, purchase of raw material minus consumption gives you closing stock. Always remember this base formula. With this base formula, surely 100 no 200% you will be able to gauge what? Tell me the purchase of raw material. If anything out of the four things asked, you can rearrange and find the answer. Correct? Purchase of raw material is what? Closing stock plus consumption minus opening stock of raw material. Always remember that production cost will apply on production units, not on sales units. But selling cost will apply on sales unit and not on production unit. These are concepts which are very basic and fundamental. You should remember these, correct? And going ahead, we have what? If you want, you can refer the Excel sheet I have given you, right, for this answer. This question you will not find anywhere in any book in India, right? This is the only question that I take up in class, right? There is a similar question in one of the books, but I have tailored the question as per ACCA requirement, okay? As per what is asking ACCA and what is available at the study hub and all those things. Then you have something cash balance forecast balance sheet method, where a balance sheet is given to you. Generally, these questions come up in section A or section B, right? A balance sheet is given to you, correct? And then certain adjustments are given, like these are given. So each component of the balance sheet, other than cash, will have its own what? Tell me, adjustment. If no adjustment given, copy the same amount. So what do I do? Generally, I copied on the same old balance sheet right? And whatever the adjustments are, you do the adjustment and get the amount. Like here you have what? Tell me, for your non-current asset, you have new asset purchase of 45,000 during the year, plus depreciation at 15%. That is tax allowable depreciation. So what do you do? In this 75,000, 70,000, you add 45,000, deduct what? On the whole amount, depreciation you will deduct at 15%. So you get 97,750 as your balance sheet amount, correct? So then account receivable is selling, it will go up by 10%. Inventory will go up by 10%. So you make them go up by 10%. Cash, so you have to find out, so you keep it as balancing.
कितना आवाज है फिर आवाज मत करवाना
At the end, it is either what? Tell me. Either what? Tell me. It can be the cash balance or OD balance, right? If the liability side is lesser, then it will be an OD balance. If the asset side is lower, right, it will be what? Tell me. Cash balance. So accordingly, you write the OD balance, correct? And go. Right? Then going ahead, you have what? Now we can go into, I think, cost of capital, right? Cost of capital, very big chapter, and also a lot of questions have come up in exam section A and B question also, and a section C question of calculating WCC. For section C question of calculation of WCC comes up, right? Consider yourself lucky, because this question is very easy, right? There are limited types of question that can come up, right? So basics of WSCC, you have, then you have KE by DBM method, CAPM approach, correct? KPS you have, then KD you have, correct? Irredeemable, redeemable, convertible, bank loan, right? Then you have something called as what? These irredeemable, redeemable, and convertible debt are marketable debt that are traded on the stock exchange. But when it comes to bank loan, it is a non-trading what? Non-traded loan, correct? Or a non-marketable debt. What weights of WSCC used to be used? Question very important from exam point of view, right? Comes up in a lot of exam. When will WSCC be used, right? Or when can WSCC of an existing project, right, be used, correct? For, tell me, WSCC be used for new project, existing WSCC for new project, correct? Theories of cost of capital or gearing, correct? The three theories that are there, and then you have a special section C question, and then at the end you have a risk adjusted WSS. Now questions have come up on theory, questions have come up on theory of cost of capital as well. Theory question have come up on this existing WCC used for new project, and theory question has also come up for risk adjusted WCC, a bit of theory which is there at the start. So stay very vigilant, right? Even CAPM theory has come up. Section A theory MCQs have come up. Section B theory MCQs have come. Correct. So have a look. So first, WSCC formula. What is the WSCC formula? Logically, it is V divided by V plus VPS. V is nothing but value of equity. Generally, market value is preferred over book value. V divided by VPS. V divided by total capital into KE plus VPS divided by total capital into KPS plus VD divided by total capital into KD. Generally, this is without tax. With tax, ka impact, taxation impact will only come on what? KD. That is there. So KD will become 1 minus tax rate. Correct? Because KE and KPS do not have a tax impact because they are paid after taxes and interest are paid. Right? So when it comes to KD before tax, KD after tax, so this is the KD after tax formula, correct? WSCC formula will have multiple brackets added as the numerous. So it is not only three brackets. If you have two types of debt, then two brackets will be there, right? For the amount and KD percentage changed. Those many brackets can be added. And then you have KE by two approaches, right? DVM approach and CAPM approach. We do generally CAPM approach at the end, right? DVM approach has two ways you can solve what? The KE, correct? So DVM without growth and DVM with growth. DVM without growth is what? Tell me. You have no growth in the dividend, right? Same amount of dividend is paid till perpetuity. One of the assumption that is taken in KE DVM approach. Equity shares are what? Never redeem. Company follows what? Constant dividend payout policy. That is same or growing dividend, right? Expected return of equity shareholder is equal to cost of equity for company. Correct? Company, I had also done the valuation of what? Shares here. Correct? Logically, the dividend that you pay. Correct? If you find the present value of that today, right? Then it will be something that can be done, right? So PV of dividend is what? $10 by 0.12, right? So present value of dividend, you find out that is nothing but the share price. But here when we derive KE formula, correct? I have derived all these formulas in class. You have to appreciate the fact. If you look at all this, I have derived how, what, tell me, the formulas are here, right? Generally, we say share price today is the true value of the share and it is not mispriced anywhere in the market. Hence, K is equal to what? D1 upon P. K is equal to what? D1 upon P0. Generally, D0 is given in. So generally, what type of question comes up? D0 is given and it will say it will grow by 5% next year and that growth will be constant, correct? Right? Or the amount will be constant up to perpetuity. In that case, D1 upon P0 will come. But if they say that the growth will be same for the coming years, correct? Then it is with growth part. Company has what market value of equity share of $128.6 per share. It will pay a dividend of $14 every year from end of year one. That means from year one, today's dividend don't consider. Then comes to D0 paid now and D1 dividend paid at end of. Dividend is just paid plus growth by dash percentage in dividend next year and dividend will remain constant after that. Example 1, right? That is one type of question. Dividend is declared and about to be paid is also D0, correct? Right? Understand? Once dividend declared, it becomes a liability and if you don't pay the dividend, it is a punishable offense. You might be jailed for it. But there comes the question where you have to take the P0. Always take P0 as X dividend share price. Because for that small amount of time, what happens? The dividend component is added in the share. So D0 is already paid, is not a relevant cash flow, hence not considered. Also, your what? Excluding dividend share price, right? Told you after declaring dividend and before payment of dividend, right? Share price will be come dividend share price, correct? So if they say that dividend is just declared and about to be paid, correct? In that case, if share price they have given X dividend share price, then it is okay, but not given. If they say share price now, correct? Then that is come dividend share price. You have to convert the come dividend to X dividend by deducting the dividend amount from the share price, correct? Because that is the true value on which P0 will be calculated. It is a temporary increase in share value. In all the questions involving share pricing or loan note, market value should be what? X dividend share price or X interest market value of loan note. Always remember. Because here you are doing from what? Company's point of view. But when you're doing from whose point of view? Investor point of view. You take come dividend share price. Because investor will get the value at what? At the real value at which it is available in the market. Correct? This is there K is equal to D1 upon P0. That is okay. Have a look at one question actually. Is about to pay a dividend of $5 which will grow by 7% in next year. And then it will stabilize after that. Share price now is 110. Calculate K. Now tell me, is the dividend already included in this or not included in this? This 110 is X dividend or cum dividend? Tell me. 110. Dividend about to pay a dividend. Cum dividend or X dividend? Cum or X? तो देखो how things work out. What do you say? बोलो बोलो.
Come dividend.
Cum dividend. So you have to reduce what? Tell me. The dividend part, right? Share price now. Share price now is between dividend declared and dividend. So after dividend declared and before dividend payment, whatever, if you are the question is in that for time frame, then your share price will be what? Come dividend. But instead of writing share price now, if I had written X dividend share price is 110, then would you deduct dividend again? Tell me. No. The next question would be something like that. I will, they have given dividend paid. Company just paid a dividend now $7 and has come dividend share price. Will you take come dividend share price? Never ever, right? So deduct the dividend. What? Tell me. Come dividend if it is there. Deduct come dividend from it, deduct dividend and do your work. Correct? Now she is about to pay a dividend of $8. X dividend share price directly given. Don't worry. Again, don't deduct dividend. Correct? Then comes a part of dividend with growth, right? See, logic of this is what perpetuity formula, correct? Dividend is paid to you, correct? The same thing. Here, dividend with growth means what? Every year dividend. So let's say I paid $5 dividend or the company paid $5 dividend. It will grow 3 years, 3% every year from now until perpetuity. Correct? So how it will happen? $5 plus 3% plus 3% plus 3% till perpetuity growth is there. So I take the basic of this, what? The derivation of the formula from perpetuity with growth. First cash flow of perpetuity with growth divided by what? Tell me. Your discount rate minus the growth rate. Your discount rate is nothing but KE. Correct? So KE, if we have to find what is the formula, have a look. Now see this formula also D1 is equal to D0 into 1 plus growth rate is also one formula. If directly D1 is not given. So your basic formula is what? A is equal to D1 upon P0 plus G. Right? If you want to know how the formula is derived, this sheet you can refer 355. Here the derivation of formula I have given. Right? Always take D1 upon P0, the whole bracket plus G. Correct? And G will always try to get it in either percentage or either in a number. Right? Correct? Generally in number if you do, it will be better. Right? Have a look. D1 upon P0. Always take P0 as not X dividend. Correct? Growth rate. Now what happens generally, what growth rate can be different from year 0 to year 1. Now this is one question. I think a lot of books don't even have this question. They will say that company is saying that they paid a dividend $5 now. Correct? The dividend will pay next year or increase next year by 7%. So D1 will become how much? $5 plus 7%. But they'll say after that, the growth will stabilize to 3%. Correct? First, from 0 to 1, it is how much? Tell me 7%. But from 1 going ahead, it is how much? 3%. So are two different rates given? Yes. So from D0 to D1, 7% is the growth rate. But from D1 up to perpetuity, 3% is the growth rate. So have a look here. It decides that it will give a 10% higher dividend next year. From second year, the dividend will grow by a constant rate of 6% per annum every year. Correct? Share price now is 517. Accordingly, we did the calculation. Have a look. Generally, these are advanced questions in the exam. So read the question very properly. Then how to calculate growth rate, right? Growth rate has two methods. Leaps method, historic growth method, correct? And Gordon's growth model or earning retention model, correct? Leaps method has a very simple formula. D is equal to what? Tell me. Latest dividend by earliest dividend. Latest dividend of D0 divided by earliest dividend raised to 1 by n. N is number of times dividend grows. Or if you have attended my classes, right? Number of bumper teeth that you can draw, correct? Not the number of years, but the number of time dividend grows. The whole bracket minus 1, right? This is from the basic growth rate formula that is there. That you had a $3 dividend which grows to $5.82, correct? So 3 into 1 plus growth rate for 4 years is equal to 5.81. That is the G ka formula ka derivation, correct? How the growth rate formula is derived, correct? Then Leaps method is okay. Leaps method where there is a hidden question, correct? They will do what? They will give you as a table, right? And they will give you D0 alag se. They will give you what? Leaps method uses the historic dividend, paid details, okay, for growth rate. Leaps method always what? Analyzes the old dividend payments, correct? And tries to what? Can we calculate growth rate for the key? Assume that the same growth rate will be forward, correct? That is a way of what? Leaps method. Then, this question is very good. Have a look. Now is 2023. Company has given you following details of dividend payouts. Year 2019, 20, 21, 22. Right? Now is 2023. Ex dividend share price of the company is 110. Some dividend is 160. So 6 का dividend is paid today. उसके पहले 5.15, 4.7, 4.25 and 4. Now, how do you suppose to solve this question? Tell me. For calculating growth rate, you have to take earliest or latest dividend at D0. What will you take as D0? 5.15 or 6? Tell me. 6. Always remember, in the table it is not given, but you have to take care that this is to be done. This is a googly question that comes up in exam, right? Has come up a lot of times. Will come up in your exam as well. If a WSCC question is to appear in the exam. Have a look. If you have any problem, if you have not seen question of this type, kindly have a look today, right? These are a bit difficult questions that have come up in the exam, right? So take care of this, right? Can I go ahead? Tell me. Growth rate, you'll find what? 6 divided by 4. And it has grown how many times? 1, 2, 3, 4. 1, 2, 3, and 4. Growth rate is 10.67%. Then you have nothing but Gordon's growth model. What is Gordon's growth model? Very simple, right? What are you supposed to do? Tell me. Find the return on equity, correct? Return on equity into payout ratio, right? Payout ratio, retention ratio. Tell me. Retention ratio. Retention ratio, correct? How do you find dividend payout ratio? How do you find retained earnings? Dividend payout ratio is nothing but dividend paid by EASH. Retained earnings ratio is nothing but retention ratio. That is what? Retained earnings divided by EASH. That 40% into what? The return on equity. Correct. So generally G is equal to B into R is the formula. Have a look. You take a view that every year constant retention ratio, right, of 40% will be maintained and reinvested into business as equity investment, which will give you a return on equity of how much? 8.33. That is the reference of above question. So your growth rate will be how much? 40% into 8.333. Have a look here. Right, that gives you a growth rate of 3.63. So G is equal to retention ratio. You are assuming that the retained earnings will be invested again in the equity, which gives a return of how much? Whatever return on equity it gives. So retention ratio into return of equity or required return of shareholder. That would be the last part of equity. K at least DVM and growth can be done with this part. Now coming to cost of preference share, right? In the cost of preference shares, right? Simple part is there, right? KPS is equal to what? D1 upon what? Market value of preference share. Simple and sweet, right? No tension of formula that much, right? The dividend will be what? Generally, the only thing that you need to remember is dividend will be calculated on nominal value of shares and not on market value of preference shares. Same thing applies for equity as well, correct? Preference dividend percentage will be calculated on nominal value of preference share. Preference dividend is equal to what? Nominal value into preference dividend percent. Always consider X dividend market value of preference. Then preference dividend is what? A fixed percentage and fixed amount every year, and hence no growth concept will. Growth concept does not apply here. Then coming to debt, right? You have two types of debt: tradable debt and non-tradable debt. In the tradable debt, you have three types of debt: irredeemable, redeemable, and convertible. Correct? Irredeemable, redeemable, and convertible. And you have non-tradable debt. It does not have a market value. That is called as a bank loan. Correct? Have a look. Then, if it is a irredeemable loan note which has a market value, very simple, correct? It's the same formula, right? Of PV of perpetuity is the derivation of the formula, correct? So the market value of loan note KD is equal to what? Interest payment divided by market value of loan note. This is from investor point of view where tax is not deducted because tax shield is received by company, not by investors. So KD, if they ask you to find KD from investor POV, never deduct tax. But if they ask you what KD from company point of view, correct? Then in that case, you do KD 1 minus tax rate and do interest payment into 1 minus tax rate divided by market value of loan note because same amount of loan note, right? It is a irredeemable debt. So never are you going to get your principal back, right? Section A and B generally if nothing is mentioned, right? And tax rate given take KD 1 minus tax rate. But for section C, whenever calculating WSCC for company, right? If tax rate not given, then KD. But if tax rate given, don't have to tell you. You have to do. Generally, section C question is for companies. What? Tell me calculation of WSCC. In that case, what you have to do? Tell me. KD 1 minus tax. Correct. Okay. And also here, nothing given. You will assume that it is what? The interest will be given, let's say 7%, and loan note ka nominal value is not given to you. In that case, you have to consider what market value is given, nominal value is not given. You can assume that nominal value is $100 because this is or that assumption is given by whom? Tell me. Nothing but or no one but the ACCA. That nothing is given. Nominal value can be considered $100 in any question, right? And always use X interest market value of loan note for all your calculation going ahead. Correct? Then come to redeemable debt. What is redeemable debt? In 4 5 years, what will happen? Your what? Tell me. In 4 to 5 years, what will happen? 4 to 5 years. Correct. Redemption will happen. So in that case, all the interest for 5 years, today's market value in negative, interest in positive, and redemption value, whatever it is at the end. Right. All the cash flows, you will find the net cash flow and find what the rate at which it should be what discounted so that NPV is equal to 0, if you remember. So we did that on Excel. Have a look at the Excel as well. It is very simple to solve on Excel. What you do, whatever is the market value, right? Yeah, redeemable debt. So market value in negative. I hope the Excel sheet is visible. Tell me. Interest payment. Interest payment. Your tax was not given. So I took normal interest payments, correct? 7.25 and at the end redemption. So total net cash flow you take and you have to find the NPV here. The present value of all the cash flows should be equal to 112.71. That means NPV should be equal to 0. That means you have to find the IRR. So is equal to IRR formula I had given. Comes for A or B. Right? You can go to section C and do it. I don't have a problem. And copy the answer here. Right? Copy the answer here, no issues. I don't have a problem. No one will have a problem. But when it comes to what section C and WSCC, you will find in suggested answers the answer given in what way? Tell me. In that IRR, that lower rate, higher rate method, correct? Don't do that. Okay. You don't have that much time in exam to find a lower, higher, and then apply the IRR formula and then get an answer. Don't do that. Directly IRR say is equal to IRR say you can get an answer. Right? The market value of loan note is 9.97.75. 6.5 is the interest payment. Right? That is how things will work out. Correct? Have a look. This is how redeemable debt works out. Okay. Any problem here? Any doubt here? Can I go ahead? Hmm. Now you'll see that on redemption, some premium will be given, right? On redemption, some premium will be given, something of that sort will happen, correct? And company has an issue 5.25% per annum loan notes with 6 years left to redemption. Redemption will be at par. That is what? Tell me. And interest is to be paid and market value now is to be paid means what? Not yet asked in exam, right? X interest and what come interest is still not asked. You never know when it will be asked, right? So interest is to be paid means what? It's shortly going to be paid. So will it become interest or X interest? It will become interest. Remember this. This question is not there in any book. This is from CA Inter book that I have taken the question. If nothing given, consider nominal value as $100. Right? That is how things work out. Then you have nothing but the convertible debt. Convertible debt, everything else is same, correct? But what happens in convertible debt? In the fifth year, right? Instead of taking the cash of redemption, you can convert the debt into equity, right? That option is there. But you have to find out if cash paid, how much will be the redemption value, correct? And if convertible value is there, how much is the expected value of shares, correct? No, no. See, I'll tell you simple. Whenever you are calculating from company's point of view, always take X interest market value, correct? And take KD after tax, correct? X interest, X dividend, all those from company point of view. But when you're doing valuation of shares from investor point of view, correct? In that case, what you will do? Tell me. You will take all from dividend. What is the value today? That you will take, right? There is a table that I've done in business valuation. I will show you that. Okay. Where to do what? Company issue. You can solve this question. No problem. Works. Then bank loan is given in two ways. Sometimes the question comes up where today's share value is given, correct? Today's share value is given today, right? And it is said that it will grow by 5% in the next 5% for next 5 years, correct? So $5 then increase. Today's share value increase every year by 5% and take it up to date of what? Redemption. Then compare it with the redemption value. Whatever is higher, take it as your convertible or redemption value. Then comes the part of bank loan. Bank loan given what? As a fixed percentage, right? In balance sheet, bank loan at 7%. If no tax given directly, KD is 7%. If tax given at 20%, then KD 1 minus tax rate 7 into 1.1 minus 0.20. Bank loan given as variable interest rate, right? Then in that case, if variable rate not given, use KD or KD 1 minus tax rate of any loan note holder, convertible or redeemable, right? Then weights of capital for WACC. Book value weights you can use, correct? Or market value weights. If nothing is given, market value weights is the favorite way to, right? Default method. Then how to find the total market value, right? So book value total in dollars of shares or loan note divided by nominal value of shares or loan notes multiplied by the market value of loan note or share, right? And also table method of WACC is always better. Have a look. You do what? Amount of capital. Let's say this is any amount of capital that I've given. Let's take a total of this. These are the cost of capital KE, KPS, KD, loan note and KD, bank loan. Correct. And then you do what? You find the weight of the capital. 180 by 400, and 70 by 400. Then you have 100 by 400 and 50 by 400. Right? This weight should always be equal to 100 because you're doing nothing but distributing the weight of this 400 individual. Then this weight cost of capital into this weight will give you nothing but your individual what brackets and add all those brackets and you will get your WACC. You can do anything you want or any question you can do by this method. That is always better because that formula method you tend to make a lot of mistakes. So follow what table method. It is always better. Correct. Special section C question that is there. I don't know whether you know this question. One question is there, whether to use equity or whether to use debt. Do you know? Law for a company. What the company will say? That they want to raise funds. Okay. They will say they want to raise $25 million. They can do it by two methods, right? They can do it by right share issue or they can do it by debt issue. Right? Both options are open. So right share issue and debt issue. Now when they say right share issue, correct? So logically in right share issue, number of shares will increase, correct? The amount that is increased will be invested into what? Tell me. Your non-current asset, correct? And what they will do? They will say that find out the EPS and market value of share if P ratio is here. So they'll give you this PBIT and they will tell you to calculate what is the impact on PBIT of raising the amount with the right shares or with what? Debt, right? So you have to analyze, right? Very good question. Love for a company. So here, what is the catch? Generally, PBIT is given to you from that debt interest. In right issue, generally debt interest will not increase. It will be same as existing. But when it comes to additional debt issue, then interest will increase because debt has interest component. Then you have profit before tax. From that, tax will be deducted. Right? You will have profit after tax, EASH, correct? Number of shares that are existing. You will get the right shares, total shares that are there. Then you do EPS. EPS and then P ratio is given. So you multiply the EPS by the P ratio, you get the market price per share. Has come up in exam, can come up in exam in the future as well. Right? La forget. Right? Special section C question from WSCC. Right? Are you okay with it? Really? Then going ahead, you have similar type of question I have taken here, right? You can have a look at it. Then we go into what? CAPM, Capital Asset Pricing Model. First, we'll go through theory of CAPM. What is the theory of CAPM? Sir, I have one stock of one industry, right? Sir, I have a lot of risk, very high risk. Here you are at the high risk point, right? Right? Sir, I go on buying stocks of different industries and different what? Portfolios. Slowly, my risk will reduce, but my risk cannot be completely eliminated, correct? So what did I do? Sir, company A is summer company stock. Company B is winter company stock. Company C is some what? Automobile stock. Company D is some oil company stock. Company E is some pharma. So what do? You take different company stocks or you try to eliminate company specific risk or it is called as unsystematic risk. Can be diversified fully, right? By what? Tell me. Buying different kind of stocks, correct? Diversify your portfolio, correct? Systematic risk or, but can you eliminate market risk or systematic risk? Not at all, correct? Systematic risk or market risk cannot be diversified or eliminated at all. If you cannot eliminate or diversify the risk, calculate the risk and include it in your working. So how do you calculate the systematic risk is beta, right? What is beta basically? If share price goes up by or if market goes up by 1%, how much does the share price go up by? If it goes up by 0.5%, that means beta is 0.5, right? If it goes up by also 1.5%, then beta is 1.5, right? That means if market goes up or down, whatever it is, goes up by 1% or goes down by 1%, how much will be the impact on what? Share price. That is not beta. So beta of each company will be calculated, or beta of each share will be calculated differently. Correct? Have a look. So if index share market means the normal Nifty or what? Tell me, Sensex that you have, right? So company shares go down by 1.2%, right? That means beta equity of companies 1 point, right? Beta is company specific. Every company share price movement compared to market index. So every company will have its own beta, right? It's not about that one beta will be there for every company. right? And you have nothing but the CAPM formula. How is the CAPM formula? What? Derived. Now you understood systematic risk beta, correct? Now understand how the CAPM formula is derived. Let's say you have 100,000 to invest in a risk-free security. You tell me, sir, I want to invest in risk-free security. I'm like, okay, you will get RF or risk-free return. Now tell me, when the risk is very low, will you have very high return or very low return? Risk is not there only in any investment.
No.
Very high return you get or low return? Tell me.
Low return.
Very low
Lowest
return.
first return. Yeah.
Risk means lowest of the lowest return. So RF is the lowest of the lowest return. But you are like, sir, 3-4%. We don't want this kind of return, correct? So we want thoda sa high return. So go into the market, right? Then you ask how much is the return that I will get. So I say average in the market, you get a RM or a return of the market, average return of the market or expected return of the market, right? Is 15%. RF was let's say 6%, correct? So like sir 9%. But sir, I want to go into that specific stock. So generally, see, when you move your funds from RF to stock market, right now, what is happening in the stock market? Tell me. RF is higher than stock market return, correct or not? Bloodbath in the Indian stock market. Tell me. Again, my portfolio was green, 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 right? Now it is only seeing red, 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 correct? So I have a SIP, right? उसमें 40% रिटर्न था, how much? IRR था मेरे पोर्टफोलियो का 40%, ना सम 2 लाख का वैल्यू था, राइट? 2 lakh invested, it had gone to almost 2,20,000 का 3 lakh it had gone. How much? 3 lakh. Now it has come down to only 8% return. So Indian stock market correction, correct? But if you go into the market, right, extra risk premium means how much? From 6% to 15%, that is 9%. So by taking extra risk of going into the market gives you a premium. That is market risk premium. So market risk premium is what? RM minus RM. But you have to have the expected return from a specific stock. So you calculate the measure of market risk, that is beta of the specific stock, and multiply it with the market risk. So generally going into the market, I will get 15%. That is 9% over the RF, correct? But sir, I want to know exactly how much will I be able to get if I go in company A stock. Then take the beta equity of company A, multiply it to the part that you are giving. So see, 6 plus 9% is your nothing but RM, correct? But when you want to go specifically into company A, then you do what? 6% plus 0.7 into 15% minus 6%, correct? I want to. This is how things work out. Then all about beta. Beta if less than 1, correct? Means what? Tell me, beta less than 1 means high volatility or very low volatility? Tell me. Less risky or more risky? Tell me. Less risky, volatility is low, correct? Share has less risk than market risk. Share risk is what? Less than market risk, correct? Share return is less than market return. If beta is equal to 1, then what will happen? Now see, yeah, all these tables, tell me how many questions are you able to solve with this table beta wala question? Were you able to solve a lot of questions? Tell me. K is equal to RM, K is greater than RM. These kind of questions have you seen in your all publication books as well as your study hub? Tell me. Yes, always. These questions are available, are asked a lot of times. If beta is equal to 1, K is equal to RM, K is greater than RM, correct? Then share risk is equal to market risk, share return is equal to market return, and share is in line with the market. If beta is equal to 0, then K will be equal to RF because there is no risk at all, correct? Beta 0 means what? No market risk, correct? If beta is greater than 1, then it is more volatility, more risky. Share has more risk than market. K will be greater than RM, correct? K will be greater than RM. Share risk is greater than market risk. Share return is greater than market return, correct? I've taken all the questions here. Whichever, whatever I've written in the table, I've derived everything here. You can have a look what if beta is 0.7, 1.5, 10. Everything I have here. Now coming to the main question, right? Mark this as LDR question. I don't know why. A feeling that this question will come up in exam. 7th March, you are in the exam hall. Don't be surprised if this question appears in front of you in exam. Correct? Very important question from exam point of view. Right? ठीक है चलो. When can existing WCC be used to appraise a new investment project? Right? Existing WCC of existing company be used to appraise if first point existing business and the new business have to be civil for WCC to be used in new. If two differing business, then existing WCC cannot be used for new business. Correct? Weight of existing capital of WCC should be same in new investment project. Weight of existing what? Capital of WCC. The main capital of the old company should be, or the weights, right, should be same in the new company. Very difficult to do that. Project specific loan for new project is not allowed. Funds for new project should be raised from a pool of funds. All these problems will be solved in AFM. When you come to AFM with me, correct? We are launching AFM batches as well. Now AFM, I think every quarter batch will be there, right? So new project should be comparatively smaller in size as compared to existing project, correct? New project should be what? Comparatively smaller in size as compared to existing project, right? So all 4 points, if they are there, then you can use the existing WCC to appraise what? New investment projects, correct? Then you have nothing but the risk adjusted WCC. In risk adjusted WCC, you have your beta equity, that is systematic risk or market risk, that is called the total risk of the company. Any whichever way, there are only two major type of risks that a company has. One is the business risk, the other is the finance risk. Business risk is related to what? Tell me. Risk of business operation, and it is denominated by beta asset, correct? And finance risk is denominated nothing by the debt to is to equity ratio. Risk of not having a proper mix of debt and equity, correct? So, how to go from total risk to business risk and business risk to total risk? That is called as gearing and degearing. If you remember the whole, what? Tell me. We had done small parts and then we had built up a big question, right? De-gearing and re-gearing of business we had done. Have a look here. So what you do? There is one company, let's say in retail business, it wants to go into a new project of cloth business, right? So can it use, first tell me, can the existing WCC be used in the new project? Tell me. Can it be used or no? Existing WCC, can you use for new project? Bolo.
Mm, No, if the market is not same, then no.
If the business is not same, you cannot use, correct? So what does the company do? First thing, it goes in search of a proxy company, which is in the same kind of business. Example, we have taken Raymond here, correct? Or whatever example I would have taken in class at that time, right? You would want to take the beta of asset or business risk from that company, but you don't have business risk already of that company. You have equity risk, right? And the formula is what? Beta asset is equal to what? Tell me. Beta asset is equal to what? Value of equity divided by value of equity plus value of debt 1 minus tax rate, right? Into what? Tell me. Beta equity. This is how you find the beta asset. So you re-gear the what? Beta equity, get the beta asset. Take that beta asset into the new project, correct? Then ask the company A, right, for what debt is to equity ratio or equity is to debt ratio you want. They say this is that equity is to debt ratio. Use that beta asset, re-gear the company. First you did de-gearing and got the beta asset. Then re-gear the company, get the what? Beta equity of the new cloth manufacturing. That beta equity use, right, with RM and RF, get the KE. That KE use in the WCC and get your what? WCC with the KD and all other details. Correct? Makes sense? This whole, whatever I said, I have given detailed steps. ये किधर मिलता है क्या? Tell me. Do you get all these kind of things anywhere in any book? Not available at all. What to use, what not to use. Correct? Have a look. Business wants to enter out into what? An unrelated business, correct? Or new project, and hence the business risk of existing business will not work for the new project, right? So you go for what? To find proxy company, correct? So you do what here? De-gearing of proxy company. But the beta asset, you de-gearing means what? You are removing the gearing or removing financial risk, correct? And getting beta asset, right? Then step 2 is what? Re-gearing beta asset. Now you got the beta asset here, right? You re-gear the beta asset and try to find what? Beta equity, correct? That is how it is. Then with that you calculate KE and WCC, right? It is also called as risk-adjusted WCC is project-specific discount rate, right? Now note, value of equity to debt should be based on market value if available in question. First preference should be given. If nothing is given about financial risk of new project, assume debt equity ratio of existing business to be applied to zero. Nothing is there, right? Now there is a analysis table of this also, which has been asked in exam, right? If financial risk of new proposed business is equal to financial risk of proxy company, then beta equity of what? Proxy company will be equal to beta equity of what? Main company, correct or not? If financial risk of new business, right, is equal to 100% equity, in that case, beta asset will only be beta of equity. काम खत्म. New business and ungeared business. Other than that, right, there will be different answers. For this, I have taken 2 questions here. To prove this, I have taken 2 questions, A and B. A, B, and C. Have a look here. काम करने का तो फुल प्रूफ करने का, राइट? डोंट डू हाफ वर्क, राइट? एकदम परफेक्ट वर्क है. Then theories of cost of capital. There are 3 theories. What are the 3 theories? Tell me. इसको देख के क्या याद आता है? Which theory is this? Tell me.
Traditional.
Traditional theory. Traditional theory में what happens? Sir, K is equal to WACC as there is no gearing. Sir, but as gearing increases, what happens? WACC or WACC falls. K remains constant, sir. Right? First you go. If you remember, I told you a story, a big story, correct? That you go to borrow. Shareholders are on the what periphery of your what business. When you go to borrow, first time you go to borrow, shareholders are okay. Then ठीक है, no problem, right? It works. Then, if that is the situation, correct? Then what happens? The WACC initially falls. The directors enjoy the fall in WACC because what is happening? Because of fall in WACC, what happens? Tell me. Value of company goes up because WACC falls. What happens? If the cash flow based valuation is to be considered FCFE, FCFF or FCFE approach, right? Then what happens? The value of company goes up. Balle balle, correct or not? But after certain point, if you overdo debt, that means if you over borrow, what will happen? Tell me. WACC will dip and your KD will increase, or the equity shareholders ka KE will increase first, correct? They will say that boss, you are taking too much debt, it's too much risky. Now you want more return, correct? And hence WACC may go up and hence value of company may fall. So there is a X point X where WACC is minimum. There is no formula for this. Every company by trial and error method uses what? This WACC or used to calculate this WACC or lowest point. Lowest point, no formula at all. Right? All this that I told. In this, at the end, what happens? You say that, sir, thoda sa rise हुआ ना, again let's go to borrow. Correct? When you go to borrow 60-70% debt, it happens no. Then even your bank says that, boss, you are borrowing too much and we are not able to borrow at 7% in this diagram. The rate will go to then 10 or 11%. The whole traditional theory I have written in words, correct? Then you have Modigliani and Miller without tax. M&M without tax. What is M&M without tax? Have a look. What does M&M without tax say WSEC. Now tell me 1 minute. Traditional theory. What is the learning from traditional theory? Should you, when you are introducing debt or when you are introducing new capital, should you introduce debt or should you introduce equity? What does the traditional theory say? Does it say do only debt, do only equity, or does it say, sir, for some time do debt and go to that minimum point, right? And then you can move to equity. Have a look. It says what? So, thoda sa debt or debt which reduces your WSCC, right, up to certain level is good. Then Modigliani and Miller theory without tax, correct? Right? 1958. What does it say? Sir, you take equity, you take debt, correct? What will happen? Right? If you take your debt, KE will increase, WSCC will remain constant, and the value of the company will also remain constant. So you take debt or you take equity, right? The WSCC is going to remain. Then comes Modigliani and Miller with tax. What does Modigliani and Miller with tax say? They understood that because of tax, right, a lot of things will change. So KD 1 minus tax, correct? So if you borrow, then your WSCC will fall, KE will go up, and value of company will go up. But every time you want money, always take debt, 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 debt. So there is a comparative analysis as well. Have a look. This is most important, right? On this, at least I'm saying, right? At least 12 to 15 MCQs are there in various books, right? Traditional theory. Initially, WSCC falls, value of company rises. Initially, KE is almost same. KD will remain constant at start, but will go up at high levels of gearing. Debt is recommended, but only up to certain limit, right? Optimum WSCC point can be calculated or cannot be calculated. Cannot be calculated, right? Then M&M theory of gearing without tax. WSCC is constant and value of company is constant. KE will always increase as gearing increases. KD will remain constant. Correct. G, that is gearing goes up, KE goes up. There is a linear relationship. This has been asked in a lot of theory MCQs. You must have read the word linear relationship. Does gearing and KE have linear relationship? Any capital can be raised, WSCC will be constant. Gearing is irrelevant in decision making, right? WSCC, here M&M theory of gearing. With taxes, what WSCC will fall and value of company will rise as gearing increases. KE will go up, so as gearing will go up. But KD 1 minus tax rate will be used instead of KD and will remain constant. G and KE have linear relationship. Okay. Growth. Growth, gearing and KE, right, have a linear relationship. Optimal gearing is at what? It says take only debt was always use debt in WSCC, right? But tell me, will your bank be willing to borrow 99.99% gearing? It will increase your rate. So Modigliani and Miller both are not very relevant theories, but are asked in exam a lot of time. Debt is risk free in M&M theory, and hence KD or KD 1 minus tax rate doesn't go up at high gearing. M&M theory में the assumption is it cannot go up, but traditionally or in reality it will go up. I think with this WSCC also gearing also there is operating gearing, interest cover ratio, and interest gearing ratio. Operating gearing, have a look, percentage change, fixed cost by total cost, fixed cost by contribution, and percentage change in PBIT divided by percentage change in sales. Correct. Generally, fixed cost by contribution is the default ratio. Correct. If nothing is given. Correct. Then you have interest cover ratio. Correct. Interest cover is what PBIT by interest paid. And I think interest gearing ratio is interest paid by PBIT. Have a look at it once. Not something that is you cannot understand. Right. With this, I think your WSCC is done. Any doubt here? Tell me. WSCC. Now I have what? Risk management, business valuation, and what? Theory. Once I'm done with that, I think we should be good to go. Do you want a break or should I go ahead with foreign exchange risk management? Break ले लेते हैं?
Yes, sir.
Yes or ले लो break. 10:16. Take a 20 minutes till last 20 minutes till I also have hot water. ठीक है? तो 1016 है, 1036 का Quickly come back. Quickly. Everyone come back. Can we start? Chalo, quickly.
Yes, sir.
Everyone back. Ayushi, Norman, Krishna.
Yes, sir.
Chalo, quickly, then we'll start. Mohit, you are back, beta.
Yes, sir.
Yes, sir.
So again, just a reminder, okay? Any skill level batch if you want to do, right? We're offering it at 6,500, okay? So instead of wasting your time 3 months somewhere else, right? Where you have paid money, right? It's better to get past assurance, right? You'll get all this recordings and everything with us, right? You'll get mocks also. You'll get like these last day revision classes as well.
5 classes, no? Classes.
Live online, weekday, weekend, both options are there. Which classes I think audit is going to be weekend, FR is going to be weekend, for audit. PM and UK tax I think would be in weekday, correct? FM तो I think you have done, so FM वैसे है weekend, but now you won't require FM. FM AFM is going to be on the weekend, right? For professional it is going to be 12,000 area, 12,000 per paper. So I am launching AFM and SBR as of now. ATX is something that we are looking to launch. ATX and SBL is something that we are going to launch, right? If you want, you can take SBR and AFM with us, no issues. Even other papers, PM you want to do, PM would be in the week, okay? But no problem on that front because the faculty I think is a 8-year-old faculty, right? Faculty for double A is we have two options actually, right? Double A faculty, the faculty that took this time around, right, is not available, but we have one faculty who's come up who's very experienced faculty for double A, right? Either it will be Prabha Shankar, tomorrow or day after tomorrow it will get final, right? Or there's a student whom I have taught, right? There are two options that I have. She passed FAA with 80 score. So I am more tempted to take her because 80 ka score means in a double A paper is way too high, no? Have you seen anyone score 80 in double A? And if I also give the paper, I will not get 80. Okay. मतलब I will not pass only double A. That's why I chose ACCA. कि वो P level में I don't have to struggle with audit, right? And I got exempt at skill level, right? Audit is something that I have never understood and will never understand, correct? Still, I am teaching one student audit, okay? He says the review is very good, okay? But I don't want to teach. For ACCA, I'm not teaching. It's at college level, right? So I don't know. I have mixed feelings about audit. Okay. But don't worry. Audit also 6,500 with the faculty is very good. Right. Whoever it is, even if it is Prava or the other student. Okay. I have told, see, simple. You have to understand over a certain period of time, no? That audit if done can be done within 20 hours also, 40 hours also, 60 hours also, 80 hours also, 100 hours also. If you do it in 100 hours, what will be the प्लस पॉइंट इज एक तो यू राइट ऑल द नोट्स 100 आवर्स बोला तो क्या नोट्स यू हैव टू राइट यू हैव टू सॉल्व मेजर क्वेश्चंस राइट सेक्शन ए क्वेश्चंस so I have told the faculty to solve minimum 100 to 200 questions MCQs in class, right? And section B questions, I have told her that if there are 10 to 10 questions each, that means almost 30 to 40 section B questions should be done in class. Not like that she's just explaining, no questions are done, right? You all know what I'm talking about, right? Just explaining, underline. No, you have to understand the topic, write short notes, correct? Then write answers out of it. Okay. Just underlining and telling you all the things, right? It's like a pravachan for you. That is how it will work out. So if anyone interested, any whichever way, once your exam is done, right, you will receive even social media, so you will receive the news. WhatsApp, you will receive the news. Also, I'll call you, right? And then we can work it out. Okay. I would urge everyone to join because passing is very important. See, you can join a class, you will enjoy the class, but if you don't pass, no, there is no logic to it, right? Passing. We have what we are trying 80%, 90% passing so that you don't get stuck anywhere. Because if you get stuck anywhere, now ask Karan, कितना 2 attempt देना है बेटा?
हाँ सर.
But end में what happens with him? We today till the end I have kept you what in that hold. अगर आपको मैं जल्दी खत्म करके छोड़ दूं, right? Life is very difficult, correct? That is the problem. करण के कितने पेपर बचे करण?
स्किल लेवल के 2.
मुझे कौन सा?
पीएम और डबल ए.
सबसे आई थिंक प्रॉब्लमेटिक पेपर वही है, पीएम और डबल ए. उसमें
हाँ
अगर आप
सर.
अटकते
ए डबल ए पढ़ा है, बस पीएम नहीं पढ़ा मैंने एक बार भी.
पीएम का थोड़ा ऐसा है कि अटक गए अगर पीएम में, और अभी जहाँ तुम लोगों ने पैसा भरा है वहां के इतने स्टूडेंट अभी के पीएम में आए हैं ना कि लिटरली ऐसे हो गया कि सर 2 ही क्वेश्चन सॉल्व किए सेक्शन सी के क्लास में. तो मेरी फैकल्टी को बोल रहे थे सर आप सैटरडे संडे में क्लास था ना, तो उसने 4 आवर्स का 5 आवर्स लिया दोनों दिन, बट स्टिल वो खत्म नहीं हुआ बिकॉज दे आर आस्किंग सो मेनी डाउट्स एंड सेक्शन सी के कम से कम he solved 4 5 questions in class, right? But they were saying that sir इतना भी हमको करवाया नहीं, right? We have to do minimum. He does 70 80 questions in class, section A B C B and C combined. ऐसे. So he's teaching PM since I think now last 8 years. I am teaching now since last 3 years. He also has a good. उसके इसमें passing percentage नहीं बोलता because he is teaching in that B2B environment, right? Where colleges में he teaches. But अपना B2C में what? We have a good passing percentage, right? So going ahead, right? If you are even looking for UK tax, PM, AA, anything, surely you should learn because ये price पे आपको पूरे market में किधर नहीं मिलेगा. I'm just doing it for students, right? कि आपको वापस पैसा भरना है because once you've paid the money, right? So instead of, see, I understand one thing. Instead of wasting 3 months, 6,500 is not a very big amount, right? Yeah, 12,000 is not a very big amount. 3,000, 4,000 a month. ऐसे आप कहीं बाहर खाने जाते हो तो 1,000 2,000 रुपया हो जाता है क्या? मंथ में एक बार तो जाते ही हो, राइट? इंस्टेड ऑफ डूइंग दैट, इन्वेस्ट इन व्हाट क्लासेस, एटलीस्ट पास हो जाओगे, बाकी कुछ नहीं, राइट? चलो आ जाओ. फॉरेन एक्सचेंज रिस्क मैनेजमेंट आ जाओ क्विकली. बेसिक्स ऑफ फॉरेक्स, टाइप्स ऑफ फॉरेक्स रिस्क, इंटरनल मेथड्स ऑफ हेजिंग ट्रांजैक्शन रिस्क, राइट? ये एक थियरी क्वेश्चन है, नॉट येट अपीयर्ड इन एग्जाम, राइट? बट थियरी बोल के इंपॉर्टेंट नहीं है. मे बी section A or B question might just come up on this, correct? In the types of forex risk, you have 3 types of forex risk: transaction risk, translation risk, and economic risk. In the transaction risk, you have forwards, futures, money market hedge, and options. So your forwards and money market hedge is practical question, right? And futures and options is only theory, correct? Current rate determination, triple PT, IRPT is there, and other may you have currency swaps, which is very basic, right? So first, the most important part is basics of what? Forex. So basics of Forex, you have 4 or 5 rules, correct? Rule 1 is what? First, writing or identifying the quote, correct? Converting the quote into secondary currency by base currency, correct? Secondary currency is what? Tell me. What is secondary currency? 1 unit of a currency or n units of a currency for 1 unit of
Units of currency.
units of currency for 1 unit of a base currency. Base currency is 1 unit of currency for n units of secondary currency. So if I say, sir, $1 is equal to 72 rupees, that means the quote is rupee by dollar or dollar by rupee. Tell me. When I say $1 is equal to 72 rupees, the rate is rupee by dollar or dollar by rupee? Tell me.
Rupee by dollar.
Rupee by
Rupee
dollar.
by dollar. Secondary by base currency, correct? Then what is the, see, if you apply rule 1 perfectly, then everything else is just a symphony. Uske baad everything will be what? Tell me. Now you have to convert dollar to rupees or rupees to dollar, correct? Whenever you have to convert, now say $1 is equal to rupees 82, correct? If you want to buy $10,000, how much rupees will be required? So you want to convert dollar to what? Rupees, correct? So to convert dollar to rupees, irrespective of buy or sell, 10,000 into 82, 820,000. So whenever you want to go from base currency to secondary currency, you will what? Multiply, correct? So we need 820,000 rupees to buy 10,000. Second is what? You want to convert a rupee to what? Dollar. In that case, what you will do? Base currency or secondary currency to base currency. Will you divide or multiply? Tell me. Divide by the rate, correct? Rupee rate by the 82 ka rate that is given to you. This is rule 2 for you, correct? Conclusion. Whenever going from secondary currency to base currency, divide. Base currency to secondary currency, multiply. Correct? Any problem in this? Tell me. This is irrespective of buy or sell. Irrespective of buy or sell positions, correct? Irrespective of what? Buy or sell positions. Right? Then coming to rule 3. Right? Rule 3 is something like this. Right? Rule 3 was for exporter. Right? What is rule 3? For exporter, will he receive foreign currency or will he pay foreign currency? Tell me. Second.
Receive.
He will sell goods to USA, correct? Receive foreign currency. That only means, can he do anything of foreign currency in his home currency or in home country? No. So will he keep that foreign currency with him or sell the foreign currency? Tell me.
Sell foreign currency.
Sell the foreign currency. That only means what? He's selling foreign currency. Buying home currency. Correct. Exporter, whenever home currency is strengthening, correct? Home currency strengthening, will he be at a loss or will he be at a profit? Tell me.
Loss.
He will be at a loss. Whenever home currency is strengthening or foreign currency is weakening, he will be at a loss. Correct or not? Tell me. But whenever home currency is what? Weakening, that is foreign currency is strengthening, he will be at what? Tell me.
Profit.
Correct or not? This is rule 3. Rule 4. Importer, right? He buys goods from USA. So will the USA guy say no, pay me in rupees, or will he say pay me in dollars? Tell me. Dollars. But in India, does he have dollars? No. We will have to what? Buy dollars. That only means what? Buy which currency? Foreign currency. Buying foreign currency means only what? Tell me. Selling home
currency.
makes sense. Tell me. An importer, whenever the home currency is trending, he'll be happy because he'll have profits. But whenever home currency is weakening, he'll be at a loss. Correct? Vice versa is also correct. But now, whenever you are importing something and you tell the opposite person, I will pay in rupees only, correct? From India, correct? Is there foreign currency risk? No. Or you are exporting, correct? You say I will receive payment only in what? Home currency. Is there a forex risk? No. Forex risk arises when importer has to pay in foreign currency or exporter receives in foreign currency. Correct? Exporter worried about, okay. Then we come to the rule 4. When there is a single rate. Rule 4 single rate इतना टेंशन वाला बात नहीं है. But rule 4 when it comes to what? Tell me. Multiple rates, right? Rupee by dollar is equal to 82.25-82.45, which means that bank is ready to buy from you at 82.25 and sell to you at 82.45. Then only will bank get a profit of 0.20 on the transaction. Tell me yes or no. Is this okay? That means, will it always be, you will, whenever you go to buy, will you get cheaper option or expensive? Tell me. Whenever you go to buy base currency, That means will you get the cheaper rate or expensive rate? Tell me.
Expensive.
Always expensive when you go to buy the base currency. When you go to sell the base currency, you get the what?
Cheaper.
And the
Cheaper.
difference between both is what? Tell me. Difference between both? Nothing but the spread, right? That the bank earns. Have a look. I would have written here. Have a look. Bank buys from customer at 82.25 and bank sells to customer. Now see, so you say that means are we going to be always at loss? See, are you going to buy as well as sell the foreign currency at the same time? Tell me. Are you going to do that? होगा ऐसा करोगे क्या? आज buy किया $100, sell किया $100. Will you do that if you are an exporter or an importer?
No.
Only one side of the transaction. So don't think too much. Sir, why always we should bear the loss? Bank should bear the loss. All that is not about. So have a look. If I have rupees, right, selling that only. So whenever a position is in secondary currency, convert it to base currency and use the rate accordingly. The base rate or base thing is what? Whenever you want to sell the base currency, you will get what? Lower rate. Whenever you want to buy the base currency, you will get the higher rate. That is what the logic is, right? If you have a secondary currency, that means you want to buy the rupees or sell the rupees, correct? You have to convert it into dollar, buy or sell, right? And get the right? So this is rule 5, I suppose, correct? Rule 4 or rule 5, whatever it is, correct?
5.
5, right? Then currency forward contract. What are forward contracts? Contract between customer and the bank where today itself a rate for the foreign currency receivable or payable after end month is locked. Generally, it's transaction based and low cost. It is one of the best way to hedge what? Transaction risk of foreign currency. Spot rate is equal to rate at which currency can be traded today. Correct? Forward rate is equal to rate locked today for a period of 10 months from now. Right? Now you can see we have applied all rule 1, rule 2, rule 3. Correct? Exporter will what? Tell me. Sell goods, receive foreign currency, sell foreign currency. That means what? Sell whatever foreign currency. That only means buy dollar, and we have done the rate and all that. We found how much will be receivable or payable after 3 months. Surely you can do calculation of forwards. Then coming managing. Tell me now, if you have done what with me, all these things, correct? Forwards with you would not have any problem. Even money market hedge, you won't have any problem. Tell me. Generally, those are easy part of the what exam, right? Managing what forex risk internal method is what dealing in home currency instead of paying what foreign currency. Leading, right? If you have a better rate, then lead the payment. That means pay early. Lagging means make the payment late. Correct? Matching and netting off means what? With some payment, you take a opposite receipt also. So you match the payment and receipt, correct? Or net it off, correct? You have more payment, less receipt, then only make the net payment that is there. Foreign currency bank account, maintain a foreign currency bank account so you don't have to what? Have the tension of conversion or do nothing at the end, correct? These are various methods by which you can manage your forex payments, right? Internal methods, these are called. Types of forex risk, transaction risk. Obviously, transaction risk is to what? Importer, exporter transaction that is there. Generally, it is short term in nature, correct? Translation risk is what? Holding company and subsidiary company books are consolidated, leading to what? Notional translation losses. If you remember, line by line item, when you translate with the rate, you have you have what? Opening rate, closing rate, and average rate, correct? It is not a cash risk at all. Then economic risk is what? Long-term economic risk due to fall in value of home currency. Exports will be difficult in the long run. Happens, right? Happens a lot of times, correct? It is a long-term transaction risk, correct? It is there. Then you have objective of exporter. You have money market hedge. Tell me. Money market hedge, the pura story you must be knowing, correct? Money market hedge. I am just revising what? Borrow what? Present value of FC receivable, right? Borrow present value of FC receivable. So we find the present value of FC receivable. FC receivable divided by 1 plus FCBR by 12 into N, right? So you have a BSI cycle, correct, for an exporter, right? FC receivable divided by 1 plus FCBR by 12 into N gives you step 1, right? How much to borrow, correct? Whatever is receivable after 3 months, right? Uska present value borrow today. So whenever you receive money from your customer, you can pay that loan off after 3 months. Then now you have borrowed today the foreign currency. What will you do about with the foreign currency today in your home country, right? To sell the foreign currency in the spot market. You will get some home currency. Now you can keep the home currency, invest in your business, or better invest it somewhere outside, correct? Invest the home currency received at home currency deposit, right? Step 2 answer into 1 plus HCDR by 12 into N, right? This will give you how much home currency you will receive from the investment after N months, right? See whether you're okay with it. Any problem here? MMH exporter. The pain that it took to make you understand MMH at that time, whenever you did your, right? Have a look. Then MMH exporter, done. MMH importer, or if you want to do medium, right? So borrow present value of FC receivable after N months. FC borrowed now is equal to what? FC receivable after N months divided by foreign currency borrowing rate by 12 into N. FC borrowed now, sell it. Sell the FC borrowed today in spot market, right? Foreign currency borrowed what? Today. Sold in the market. You will get FC or home currency received today. That you will have to invest, right, at the home currency deposit rate. That is 1 plus HCDR by 12 into it. BSI, borrow, sell, invest. Borrow. First step will always be foreign currency. So borrow foreign currency and always present value. So present value of foreign currency, right? Borrow present value of foreign currency after N months. Third step will always be home currency, correct? Always be future value, correct? So invest today, get a future value. Same thing here when it comes to what? Tell me. Here, when it comes to what? Tell me. Importer. Importer mein how will you do it? Tell me. Importer mein have a look. What is the basic? Have a look note. It is what? IBB. Car. Car of IBB. What? Brand, right? Invest, buy, borrow. Invest present value of FC payable after N months, right? FC to be invested today, right? FC payable divided by 1 plus FC. You are going to invest. So it will be 1 plus FC DR by 12 into N, correct? Foreign currency to be invested today. Buy the foreign currency to be invested today. Now you don't have that foreign currency to invest, right? So you go and buy the foreign currency, right? Now, for buying the foreign currency, you require home currency. You don't have the home currency, correct? So you go and borrow the home currency, correct? That is how things work out, right? Have a look. Makes sense. IBB, invest, buy, borrow. Any doubt in this? Tell me. At least if you are my student, this should be very thorough because we have done a lot of detailed analysis of this. Tell me. Any problem, anyone? Want to go into detail of anything? Tell me. No? Can I go ahead then? Can I go ahead? Exporter will benefit in MMH if he had shortage of funds, obviously. The importer will benefit in MMH, he has extra available. It has come in an MCQ in exam, right? Then Mr. A has $70,000 payable, okay. So forward and there will be a question which will say what is better? Forward is better, yeah, MMH is better. So you have to find out what receivable, home currency, receivable or payable in both the parts, correct? Or in both the options, right? And then do it. Then coming to purchasing power parity theory, triple PT, purchasing power parity theory, correct? Purchasing power parity theory, triple PT, right? What is triple PT all about? Tell me. Triple PT कितना है देखो. How do you calculate triple PT? Triple PT, does it help you to calculate expected spot rate or expected future rate? Tell me. Triple PT.
Expected spot rate.
Expected spot rate. So if you have a rupee by dollar rate and you want to find the expected spot rate after 1 year, right? So ES0, that is spot today, into 1 plus inflation rate of secondary currency by 1 plus inflation rate of base currency raised to n is number of years. But there is a problem here. What happens if there is a change, correct? If instead of years, they want you to find expected spot rate after 6 months, do you do 12 by 6 or do you do what? Tell me, percentage wise. देखो जरा. If ES is asked ES1 or ES2, or ES is asked for ES or ES 6 months or 3 months, how do you do? S0 into what? Tell me. 1 plus S0 into what? 1 plus inflation rate divided by 12 into the number of months. I hope you remember this. Tell me. If it is S1, S2, S3, then raised to n, correct? But if it is in number of months, it will be what? Divided by 12 into m, right? Divide the inflation rate by 12 into the number of months. Don't forget this. Huh? In exam, a lot of times this question comes up and you are completely confused how to go about with it. Okay. So kindly take care that you don't get confused, right? ठीक है. Okay, triple PT to get expected spot rate. Any problem in this? Then coming to IRPT, right? Purchasing power parity. Theory is very important. Any basket of goods will have what? Same value all over the world, depending on spot rate today, right? The currency or country with the higher inflation in the short term and continuing, right, will have a weakening currency over the long term, correct? Value of rupees weakening over years compared to currency having lower inflation rate, that is dollar strengthening. अभी तो it is at the all time high. बराबर है ना? The situation right now in the market. Tell me. Gold
Yes.
है क्या?
गोल्ड तो हाई है सर अभी भी.
गोल्ड कितना? 1 लाख पे पहुंच गया? कितने पे? कितने पे पहुंचा? आज गोल्ड का क्या रेट है? आई डोंट नो. गोल्ड रेट टुडे 87,000. मेरे को बोला था किसी ने 5 साल पहले that gold will go to what? 1 lakh. At that time, a lot of people said what? कुछ भी बोलता है, right? 70,000 पे गया था तभी भी सब बोल रहे थे it will go to 1 lakh, correct? तो होता रहता है, right? Now coming to IRPT. IRPT is what? Tell me. Interest rate parity theory. Interest rate parity theory helps you to calculate what? Tell me. What is it?
Expected rate.
Expected future rate, correct or not? Future या forward? Forward rate है. Expected forward rate. Expected forward rate F0 after 1 year. That is today's forward rate for a transaction after 1 year, 6 months, whatever it is, correct? So the formula is what? EF0 n year is equal to S0 into 1 plus interest rate of secondary currency by 1 plus interest rate of base currency raised to n, correct? Then here same thing will happen. Same thing that we did here. Triple PT. Month wise you have to do calculation like this, right? Same cut copy paste applies to IRPT as well. If they ask you what, tell me in number of months, then do divided by 12 into number of months of the interest rate, correct? And find the forward rate. Interest rate parity is what? The real rate of interest all around the world will be the same. Interest rate of countries will be nominal rate, and the country or currency which has higher interest rate in long term will weaken, correct, or lose value, right? What happens here generally? The country which has higher interest rate will lose value. India, country with lower interest rate or inflation rate, will be what? Will have a powerful currency compared to country who have higher interest rate, because it is shown so. In IRPT or triple PT, S0 will be average rate for bid race. Bid ask rate is given. Now in a lot of situations, they have even taken the higher rate or they have taken average rate, right? Now there is no clarity of ACCA on this, correct? क्या लेना है? So if generally if it is more of higher rate that is taken, I would say that take higher rate only, right? In IRPT use borrowing rate as interest rate, correct? If borrowing and what deposit both rate are given. Currency swaps are what? Tell me. Indian company wants to borrow dollar, US company wants to borrow rupees. If they both borrow, if Indian company borrows dollar in India, it will be expensive. USA company borrows rupees in USA, it will be expensive. So Indian company borrows rupees, gives it to the US company or subsidiary of US company, and USA company borrows what? Dollars and give it to the Indian counterpart of in USA, right? Both have absolute advantage in borrowing. Correct? But I think basic part of forex, I think we are done, right? There's only this four-way equivalence, right? That is there. I think I've covered that into the theory part. So theory notes I'll give you today. Interest rate risk management, right? Basics of interest rate risk. What are the basics of interest rate risk? Very simple, right? When will interest rate risk arise, right? What are the types of interest rate risk, basis risk and gap exposure? Hedging interest rate risk, you have the forward rate agreement, interest rate futures, interest rate options. Both these are theory questions, right? Forwards or FRAs are only practical. And you have something called a yield curve theory, and then you have interest rate swaps, correct? Interest rate risk, when does it arise? For a borrower, he's always worried about what? The interest rate going up. For a depositor, he's always worried about what? Tell me. The rate going down in the future. So this is the interest rate risk that is there. Then you have something called as types of interest rate, fixed interest rate and variable interest rate, right? Fixed rate of borrowing or fixed rate of depositing. If rate is going up, if you feel the rate is going to go up, what should you do? Borrow fixed or borrow variable? If you think the rate is going to go up, tell me.
Fixed.
Fixed rate. If the rate is going to go down in the future, correct, you will
Variable.
borrow at variable rate borrowing now. Then types of interest rate risk, you have what? Basis risk and gap exposure. Basis risk is what? Certain variable rates are based on, see, obviously you don't have one variable rate, correct? You have various variable rates, right? Some may be based on what? Central stock exchange or central bank rates, and some might be on what? State bank rates, correct? Then there is something called as gap exposure when you have interest sensitive assets, right? Are higher than interest sensitive liabilities, it is a positive gap exposure, correct? When assets are more, that means you are going to receive more interest and pay less interest every time or at every interest payment date, then there is a positive gap exposure. Interest sensitive assets are less and interest sensitive liabilities are more, correct? In that case, higher interest paid, right? There is negative gap exposure, correct? That is how things work out.
Can you repeat the basis risk?
Basis risk is simple. You have a variable rate for 5%, and you have another variable rate 6%. One is based on central bank rate, that is, one is based on RBI, and that is based on SBI. Correct? The basis can be different. So generally, you say that only one rate on in the whole market. It is not like that. So in you have LIBOR, you have MIBOR. LIBOR is based on what? London Stock Exchange, correct? MIBOR is based on what? Mumbai Stock Exchange. Is there a one variable rate all over the world? Even in India, you have Mumbai Interbank Operating Rate. You have a different rate for borrowing in India, correct? So those are different rates that are based on different basis, correct?
Okay, sir.
Then you have forward rate agreements. What are forward rate agreements? Remember two very important things of forward rate agreement. What are the two important things? Whenever a borrower wants to deposit, now see what is the FRA all about? Today only you decide, correct? Yeah, four-way equivalence I'll do at the end. It is there on the very notes. I'll explain it. Sorry. Okay. When borrower or deposit wants to borrow or deposit certain amount after n months for n months, that means what, after 2 months for 5 months, those kind of concept in the future, right? In that case, you use forward rate agreement. You right now only decide the rate of borrowing after n months. If the rate is, if let's say borrowing or depositing, whatever you decide today only. Now tell me on the date of the transaction, when actual borrowing or depositing should happen, will the borrowing or depositing happen at the FRA rate or will happen at the market rate? Tell me.
FRA.
FRA. याद करो. Bank
Sorry.
will borrow at transaction date. देखो जरा.
Yeah, bank will borrow at the market rate. Sorry.
Bank will borrow to you or deposit, it will accept at the market rate. But what they will do? If you have won the bet, they will pay you extra. If you have lost the bet, then you will pay extra. If you remember, correct?
Yes, sir.
Have a look, a question here. So at 10% you have won the bet, correct, of borrowing. Then what has been done? Tell me. The you have taken a 8.5 ka what? Borrowing ka FRA. It comes out to 10%. First tell me, 8.5% is your FRA rate. The market rate is 10%. This is a borrower's issue. Tell me whether the bet is won or bet is lost. Tell me.
1.
8.5% borrowing ka FRA, 10% market rate. Tell me.
1,
One.
sir.
What? Tell me. Won or lost?
1, sir. We are
Won the
paying less market rate.
but your borrowing will happen at what rate? 10% or 8.5%?
10%.
10%.
But the bank will pay us.
Bank will pay us what? The 1.5%. So questions have been asked at what rate borrowing will happen or at what rate interest will be paid on basic borrowing, right? And how much will be the profit or loss that will be paid by whom? This bank to this person or this person paying extra. Now the market rate goes to 6%. Borrowing happens at what? 8.5 or 6%? Tell me. 6%. And you will pay 2.5% extra to banks. Basic borrowing happens at 6%. Borrower's FRA rate greater than the market rate, correct? You won the bet. Borrow at what? Market rate, bank will pay, correct? Obviously, if FRA rate is greater than the market rate, correct? In that case, you have lost the bet and you will pay the difference to the bank, correct? Right? And here IRG can be used, interest rate guarantee, because loss, IRG can help you what? Help you what? Tell me. Avoid the losses, correct? Now coming to depositor, have a look at depositor. Depositor also, what will happen? If he has taken a 6.5 FRA, right, and the rate in the market goes to 4%, he will be happy. He is going to get how much? 6.5. But bank has lost the bet, correct? You have won the bet. Bank will pay interest on 4%, correct? Because borrowing will happen or depositing will happen at what? 4%. But bank will pay you how much? Extra 2.5%. But if it goes to 8%, you have lost the bet. You have to do borrowing at 8%, depositing at 8%, but you will have to repay how much? 1.5% back to the bank for any whichever number of months, right? If FRA rate is lesser than the market rate, lost the bet, correct? If FRA rate is greater than the market rate, won the bet, correct? That is how it will be. Wherever you face losses, you can take an IRG. IRG is given option to enjoy the upside in a FRA and lapse or avoid what? Downside in an FRA, right? If you can predict the movement of interest rate, right? Use FRA, correct? If you can predict, then use FRA. That you know it is going to go up or go down, then use an FRA. But if you are uncertain about the movement of what? Interest rates, where it will go, so it will go up or it will go down, right? In that case, use IRG, because if there are losses, IRG will save you from losses. IRG gives you an option, an extra premium, hence it is more expensive than FRA. IRG can also be termed as what? An insurance policy, because it cannot or it will not let you lose anything, right? Derivatives are what? Instruments which derive their value from what? An underlying asset. The underlying asset and derivative are sold in two different markets, because there are two parallel markets going on. Only the rate is derived from what? Tell me that one part. If derivatives generally only promises are given and accepted. Actual asset is never exchanged, correct? Then I have taken foreign currency futures जो ऊपर थे. Here I have taken, correct? Have a look. Foreign currency future contracts, right? If you are an exporter of foreign currency receivable, what you do? Tell me, you sell futures now, and then later on transaction date, you buy futures to close the transaction. For importer also, you do what? Buy foreign currency futures now, right? And sell it on what? Tell me the future date to square off the transaction, correct? And generally, theoretically, spot rate today is equal to future, but there is a basis risk. This is also called a basis risk. Where futures and spot are not at the same level, that also means there is a basis risk. Spot is based on some other basis and future is based on some other basis. Generally, they should be based on the same basis, but at times it may so happen they both have different basis, correct? That is there. Then you have foreign currency options. Foreign currency options are very simple, right? You have a put option and a call option. The way to remember this is what? If an exporter, right, has to buy, correct? He has to exporter has to what? Sell. So he will always have a right to sell or have a put option, correct? That is how things will work out here. It will be the forex option. Buy put option, right to sell foreign currency after end months. Exporter will use this. He will receive foreign currency, sell foreign currency. Importer pays foreign currency, so he buys foreign currency, so he will buy a call option. Put is always what? Put ka direction is like this, so he is selling, right? Call ka direction is like this, so he is what? Buying. So put will always be right to sell, call will always be right to buy. And coming to interest rate futures, as a borrower, you sell interest rate futures now, correct? Nothing more is required in this, right? That's why I'm only doing this much. On transaction date, whatever you sold, right, close it off by buying the interest rate futures to close off the transaction. Depositor, buy interest rate futures now, correct? And on transaction date, sell interest rate futures to close off the transaction, correct? It is a contract to invest money. You have interest rate options. You have a cap, you have a floor. A borrower takes a cap. He says that maximum I'll pay 8%. उसके ऊपर the rate goes, I'll still pay 8%. उसके नीचे the rate goes, I will what? Lapse the option and what? Tell me, go there and borrow from the market, right? Or if you are a depositor, you will buy a floor. You will say minimum I need what? At least 5%, correct? If it goes below that, still I will force the opposite person to pay only 5%. If it goes above that, correct? I will lapse the 5% option and take the upper route. Then comes the caller. Correct? Caller is what? Tell me. Depositor's caller. Now see what happens here. For a borrower, he wants to write to pay interest. Pay interest. Pay interest means what? This is what? Tell me. Put option. So he will buy a put option. Depositor, whenever he wants to what? Tell me. Receive interest. So he has the right to receive this. How this will come, correct? So it is a call option, correct? For borrower put option, right? Buy put option and sell call option. Right? Buy put and sell call will be a borrower's caller, right? And sell put and buy call will be a depositor's call. I don't want to go into the detail of this, but honestly speaking, only this much would be more than enough. This is a borrower's caller and this is a depositor's caller. Okay? Now there is something called as yield curve theory, right? In yield curve theory, in section A and B, it has come up a lot of times, right? And a very important part of your exam. There are three theories: liquidity preference theory, market segmentation theory, expectation theory. Liquidity preference theory is what? Instead of getting money now, or let's say you take your money for 1 year, I will ask 5%. 2 years, I will ask 7%. 3 years. So more time you take up the liquidity from someone, right? The more return he will ask. Market segmentation theory, right? There are different players or segment of investors in the market: retail, wholesale investor, UTI, mutual funds, and are insurance companies. Then there are retail investors, correct? Retail investors, wholesale investors, and UTI mutual funds. These are three different segments, right? A kink is noticed where a retail investor tries to go wholesale and a wholesale investor starts, correct? There is a kink that is there, and it happens because market forces are weakened there. We catch there. An MCQ of this part has been asked a lot of time in exam. Then there is expectation theory. You always expect more returns, right? In dollars, even if interest rate is same in different type of bonds. 1 year bond or 2 year bonds, correct? 2 year bonds, obviously we want more. What? Tell me. Returns, because money is taken up for more time, correct? Then yield curve theory. हो गया. Interest rate swap is what? Company A has a fixed rate borrowing, but it wants to borrow into or wants variable rate borrowing. Company B has variable interest rate borrowing, but wants fixed rate interest rate borrowing. They swap the what? I mean, borrowings, right? This is what your interest rate swaps are. Now coming to those forex notes, just a second. Well, forex here, you know, difference between what? This has come so many times in exam that I cannot even count these notes. Minimum 12 to 14 MCQs in most of your books are based on these two pages, correct? A difference between forward, future, options, right? Forwards are generally over the counter, futures are generally exchange traded on the US stock exchange. Options can be over the counter as well as what? Tell me, exchange traded. Forwards are always transaction based, futures are not transaction based, correct? Options are not transaction based because these are what? Betting tools, correct? Forwards have fixed date of maturity. Futures and options have 3 months maturity, right? For options, so you can go anytime and what? Exercise the option, correct? Futures generally have 3 months maturity, right? Forward market may there is a counterparty risk that is involved, correct? But when it comes to future and option, because of it being on the stock exchange, the counterparty risk means what? Someone defaulting in the transaction, either bank not paying or customer not paying. For forward, only what normal agreement is made. So very low cost or no cost. But when it comes to futures, correct? You have to pay margin money, and for options it will be premium to be paid, right? When you come to AFM, futures and option solving is there. We did right now in one batch, right? Students enjoy this, right? It's very difficult, but then when you write the procedure one by one, it's very easy. Okay, less flexible, more flexible, correct? Why forward less flexible? Because on that date only you have to come and what fulfill the transaction. But when it comes to what, tell me, future and option, more flexible. Anytime you can go and close the transaction. Correct? Forward is more time consuming. Correct. Future is less time consuming. Correct. Then forward is what, higher number of currencies. Right. Narrow range of currency. Correct. Forwards are available in a lot of currency because they are transaction based, and you may have export import in a lot of countries. Correct. Futures may have what, narrow range of currencies because they are on the stock exchange. Forwards and futures do not have an insurance policy or not don't provide an insurance to you. But options what will never let you lose, right? Suitable for small amount of currency forwards, right? Futures are always on big currencies because actually you don't have to pay the money. Only difference you have to pay, correct? Contract size or something of that sort. Forward will be as per your invoice, how much is the amount. But when it comes to future options, correct? The contract size is what? Fixed, right? You will see in AFM that how the contract size is fixed. Then in forward, it is a tailor-made transaction. But when it comes to future, the contract size is fixed. Generally, forward is what, tailor-made transaction. That means as per your amount, this will be there. Correct? Makes sense. Tell me yes or no. Can I go ahead? Tell me. Or
Yes, sir.
right? You want to go into business valuation? Or you want a break? Because business valuation हो जाएगा. Let's do half business valuation, then take a break. 11:30, 11:35 तक break लो. आ जाओ. Reasons
Sir,
for value. हाँ,
you'll revise ratio as well, no?
हाँ,
Ratios.
ठीक
Okay.
है. And उसके बाद I think end में there are 2 or 3 ratios I would have taken.
Okay. Thank you.
Pecking order here I would have taken. ये सच है ना, इधर ratios लिया ना end में. Some questions also I would have taken. उसके पहले 4-way equivalence. देखो कोई पूछ रहा था ना 4-way equivalence. है इधर 4-way equivalence. देखो STO process STO. अभी ये वाला this also STO becomes very important this time around. ठीक है, मैं लेता हूँ मेरे हिसाब से. मैं एंड में मैंने किया हुआ है वो, राइट? डोंट वरी, आई विल टेक इट बैक. रेशियोज में तो आई थिंक देयर आर ओनली 2 or 3 रेशियोज दैट वी हैव नॉट कवर्ड. नहीं, 2-3 रेशियोज लेना. ठीक है. बिजनेस वैल्यूएशन. बिजनेस वैल्यूएशन इज व्हाट, रीजंस फॉर वैल्यूइंग अ कंपनी. Is a theory question. Why do you value a company? When you want to buy or sell a company, right? You will have to value the company or business, right? When you want to buy shares in a listed company, right? Companies are valued at listing on stock exchange. If share of unlisted or unquoted company is to be bought or sold, what you will do? Tell me. You will value the company or business. There are 3 asset-based valuation methods. net book value method, net realizable or net replacement. Net book value is very simple. All book value asset minus all book value liabilities. When I say all book value liabilities, I mean what? Non-current liability and current liability, right? Or equity, share capital, and reserves, whatever, whichever way you want to go, you go. When it comes to net realizable value or net replacement cost, right? It is what net realizable value of asset. You will have to ask yourself every time, right? This is a non-current asset. How much you'll get out of this? That much only you'll add into the asset minus the liabilities, right? Whatever are the net realizable value of liabilities, you'll get the net realizable value of what? Equity share. Divide that by number of shares, you'll get per share value, right? There are certain assets for which companies are sold, correct? Assets are important in the company. So net replacement cost is what? Tell me. Asset stripping, only selling what? Valuable assets, right? Not selling the whole company as a whole. So value of the company is because of the value of the asset. So value of the asset only will be the asset or value of company, right? Then you have P ratio based valuation. P ratio is what? MPS by EPS, right? That can be written as what? P ratio is equal to MPS into number of shares divided by EPS into number of shares, gives you P ratio is equal to market capitalization or total market value divided by earning attributable to what? Equity shareholder. When you rearrange this, right? EAESH into P ratio will give you what? Market value or market capitalization, total market value, right? And EAESH is always after what? After tax or before tax? Tell me. EAESH. After or before? After tax. If company is an unlisted company and you want to take over that company, the method used is what? Total market value of unlisted company is equal to EAESH, not today's EAESH. It will be future earnings after takeover. Let's say I'm taking over a company. So let's say it has 500,000 as earning. But if it comes, I take over the company, it will have 600,000 earning. Why? Because I will do a lot of improvement. Correct? I am a better person to take care of the things. But when you are taking future earnings, right? Whenever you are adding any future earnings, right, into the EAESH, it should be after tax earnings. So existing EAESH of company plus cost saving after tax due to the takeover minus cost, extra cost if to be done due to takeover, correct? That will be after tax. Future EAESH after takeover, correct or not? Industry specific what PE ratio will be given to you. So always remember EAESH is future EAESH. I think in old notes this would not be there. Tell me. But in new notes it is there, right? Have a look. I have done one or two questions also on this. Then you have what? K is a valuation of P0, that is share, that you can do. Earnings yield method, have a look. Same like P ratio. 1 by P ratio is equal to earnings yield, correct? So the same thing with earnings yield you can do. DVM approach, tell me. For valuation only equity shares, tell me. K is equal to D1 upon P0. P0 is equal to what? D1 upon K. With growth, it will be what? P0 is equal to D1 upon K minus G, right? Then here, valuation of preference share, ठीक है. Market value of preference share is equal to D1 upon KPS. This one, right? Valuation of debt is what? Tell me. Irredeemable debt. It is equal to interest on loan divided by market value of loan. Always remember, right? But here, will you take before tax or after tax? Tell me. Always before tax. Whenever you're doing this, it is going to be always investor point of view, right? So look, then when it is convertible, right, the same thing will happen. You will take what? Interest before tax redemption value and try to find what market value. Have a look here. KD for WACC of company. Tell me market value of loan note, interest cash flow after tax, redemption value or convertible value, whichever is higher. Use IRR approach to KD minus 1 minus tax rate. ये हो गया WACC. Now come KD from investor point of view in WACC. Market value of loan, interest cash flow before tax, RV or CV, whichever is higher, IRR approach to KD. If you have to find KD, but if you have to find market value of debt, you do what? Interest cash flow before tax, redemption value or what? Tell me. Convertible value, whichever is higher, expected return of loan note holder will be given, and you have to discount and find the market value. Karma, you are asking this only? Tell me. Karma there? Tell me.
Yes, sir.
This is
Understood.
a new table that I have given. right? Whenever in valuation of equity, always use what? Come dividend or come interest price. याद रखना. Correct. Whenever in cost of equity or debt, always use X dividend. Right. Whenever you are in WACC, always X interest, X dividend. But when you are in valuation, so look at what question has been correct. Right. With this, I think there is that small part of synergy or वो वाला part था ना. Efficient market hypothesis क्या? I have notes. Wait. Here I will complete quickly. Have a look at efficient market hypothesis. देखो जरा. EMH. Is the EMH sheet visible to you guys?
Yes, sir.
Try EMH.
Yes, sir.
So EMH, efficient market hypothesis, right? There are 4 types of what. See, what is EMH used for? Correct. What happens generally is whenever a share price is there, correct, and there is any news that comes up, right, on the stock market, how quickly will it respond, or will your share price respond to that news? Correct. If it responds quickly, then how it should work out. If it responds slowly, how efficient are the market? No efficiency means no reflection of any information at all. Stock market does not care, or the rate does not go up or down by any kind of news that is there. Correct. But if information is reflected, but it takes a bit of time, like in the old 70s, 80s, what used to happen? You had a radio, correct? The news used to get circulated on the radio. Same day, news would not come, right? Today's news would either come tomorrow. Radio ke pehle bhi it was only what? Newspaper, right? So newspaper, may the news used to come after 4-5 days, correct? So information is reflected, but it takes time for the information to reflect on the share prices, correct? That is a weak form efficiency, correct? Semi-strong means what? It is straight away reflected as and has an impact on share price at the same time. Profit what? Booked or profit given. उसमें directly what a profit का announcement and directly share price पे the impact will be there. Coming to what? Strong efficiency, right? All information is available to public. There is no novelty. You don't need to announce anything. Everything is known to everyone. Right? What reason needs to change in share price? No information is reflected to share price. Changes are very random. Right? Very random changes. What can you? When can you make super profits? If you analyze the technical part, that is change in share price in the past, and try to make what forecast for the future, you can make super profits. Has come up lot of times in exam. I would urge everyone to please look at these notes. Information has an impact on the share price, but there is a delay. Whoever has the information first, person who finds out news earlier will earn super profit, right? Harshad Mehta, correct? He found out the news earlier and did what? Trading, right? ऐसा है. Share when it is a semi-strong form market, information is reflected at the same time it is made public. Right now, everything is on social media, correct? The person who has insider information, that is private information, will earn super profit. Who knows this is going to be announced in next week or next month? Already, if he knows it, then he has a upper hand or has what insider information. Correct? You have what public and private is known to everyone. इसमें hence there will be no impact on share price at all, as everyone knows everything. कुछ नया बात नहीं है, correct? And there will be no way to earn super profit other than pure luck. Correct? So there are a lot of MCQs asked on this. You can have a look at it. Let me open up the theory wala note. Wait. देखो जरा theory में we have first chapter also remaining, no? बराबर है ना रे? First chapter भी remaining है. Tell me. इधर क्या क्या
Yes,
theory?
sir.
8 also I have taken as 7. This is not the full marks, बेटा. ओके, काम करो, एक 10 मिनट्स का ब्रीदर ले लो, उसके बाद विल डू ऑल द थ्योरी. ठीक है, ले 10 मिनट्स का ब्रीदर. 11:38 हो गया, 11:50 तक आ जाओ. 12 मिनट्स का ब्रीदर ले लो. चलो quickly come back, everyone back. What I'll do, whatever is theory after this, I'll do that, right? उसके बाद I have all these theory notes. Okay, just stay here. Okay. Come to this STO, favorite part of the examiner. Technical article was there, and on the study of also this part has been added. What is a securities token offering, right? It is nothing but a digital representation. It is as good as share only, correct? But instead of share, it is what? A digital token that is given to a digital representation of what? Ownership in asset like gold and property, right? Generally and in shares of company or ownership of company. Generally shares के जैसा ही है या gold के जैसा या property के. It is just divided into what? Small parts and sold to you, correct? That is how it works out, correct? So have a look. STO, securities token offerings, correct? A blockchain system is used to what? Tell me. Get this secure, right? So STO का process, what is it? Preparing a deck or what? That is future business plan and other detail. Nothing but what? A business plan, correct? How the business will work and how it will go ahead. Designing the offer, that is number of STOs, how many number of STOs, what will be the value of STO, what will be duration of. STO means what? Securities token offering. It is protected by blockchain technology, correct? So whenever it is sold from one person to another person, it does not keep a what? Log of the older person, right? That is how it is. So designing the offer, selection of service provider, correct? Choose the appropriate service provider who will provide security to the STO, correct? And then raising capital on the securities token. So give securities token to people and take money from them, right? And then listing of STO, that is securities token on the stock exchange. So those market, there can be an active market and shares can be sold or purchased on this, right? Then I think four-way equivalence is what? You have triple PT, IRPT, right? With international Fisher effect, correct? You break down this interest rate into two parts. What is it? The base rate, correct? That is the real rate and inflation. Real into inflation and percentage will give you the nominal interest rate. Consider this as the nominal interest rate because obviously it will be nominal interest rate, correct? So breaking it up into 1 plus what? Real rate into 1 plus inflation rate, right? So if you break it up and you bring inflation rate from here, right? Base rate to is same in all the countries all over the world is the basic assumption of what? Tell me. Four equivalence. So base rate cut होगा, inflation rate cut हो जाएगा. You have what? ES1 is equal to EF1, correct? So by the expectation theory, both of them have to be SIA four-way equivalence. Have a look. Then I think I did beta equity beta equity will always be greater than what beta asset, correct? Because there is going to be then pecking order theory. You have pecking order theory of, or it is nothing but preference of raising finance. So whenever you go to raise any finance, correct? First preference should be given to retained earnings. Second preference should be given to debt issue, bond issue, correct? Right? That means first secured debt, second unsecured debt, third preference shares. And third preference should be given to equity. Usme bhi right share should be given. So generally a question comes, right? That as per pecking order theory, rate the what? Preference. So retained earnings will be first, secured debt second. As in debt mein first preference is secured debt, second preference is unsecured, third is preference share. Correct? Have a look. And then right shares and new share issue, correct? With this, I think this part gets over. Now come to chapter 1. Quickly come to chapter 1. Number one, FM functions, correct? The basics of FM, definition of FM, that is there, correct? Plus TSR. We will look at definition of FM. Efficient acquisition, efficient allocation of what financial resources to achieve what the objective of business, correct? Decisions of financial management, manager, investment decision, financing decision, investing, a dividend decision. You won't believe what in AFM, एक chapter है तीनों decision पे. There is one chapter on dividend decision. There is one chapter on financing decision. There is one chapter on investment decision. When you come to AFM, right, these will all go into detail. Where to invest the money, how much to invest, correct? From where will you raise the money, correct? And how much dividend to be. Objective AFM, there are two objectives, primary and secondary objective, two types. Primary objective is shareholder wealth maximization, and secondary objective is profit maximization, market share maximization, growth in EPS or geographical sale location, social and environmental responsibility, growth in geographical location written it differently, and customer satisfaction. The famous question in exam, which of these are financial objectives? So shareholder wealth maximization, profit maximization, EPS, correct, are financial objectives. Market share maximization, social environment responsibility, your growth in geographical location, and customer satisfaction is a non-financial objective. Correct? Then comes the part of your TSR or total shareholder return. TSR formula is nothing but total dividend received during the year. That is nothing but your interim dividend plus your final dividend plus share price at the end of period minus share price at the beginning of the period. The whole divided by share price at the beginning of period. Now a lot of questions have come up where not only share price, not only TSR is asked, but share price now is asked at the end of 1 year. One question says today share price is 110 and 1 year ago how much is the share price? Find out that. That question has also been asked in exam as well. Then there is stakeholder theory. You have shareholder versus stakeholder, types of stakeholder conflict. You have shareholder versus stakeholder. Shareholders are what? Owners of the company. Stakeholders are the one who are impacted by every decision by a company. Then types of stakeholders, you have internal, connected, and external stakeholders. Internal stakeholders are director, manager, employees. Connected stakeholders who have what high impact of any decision, that is nothing but a competitor, shareholder, debt holder, or a customer. And when it comes to external stakeholder, these are external to the company, correct? Government, pressure group, regulators, society at a large. Two stakeholders might have conflict, correct? Right? You can read about that, not very important from exam point of view. Agency theory, a bit important, correct? A principal agent theory, where a principal appoints an agent deals with third party on behalf of the principal. Any act of the agent will be binding on the principal. Correct? Then there is something called as managerial remuneration or reward scheme. Correct? The managerial remuneration or reward scheme, right? The points to be considered while making or drafting a managerial remuneration scheme should that it should be clearly defined, impossible to manipulate, and easy to monitor. Link reward with what? Tell me. Shareholder wealth maximization rather than profits or anything. Correct. Match manager's time horizon and director or manager or director's time horizon with the time horizon of shareholders. Right. Manager is thinking only 1 year, 1 year, 1 year. Shareholder is thinking 5 year, 5 year, 5 year. Encourage manager or director to adopt same attitude to risk as shareholders. ESOP, I think I have done in the theory notes, correct? So I think I opened the theory notes here. इनको इधर first ESOP भी है क्या? ESOP, employee stock option. ESOPs are given to us employees who fulfill certain experience level, that is minimum 2 years, and ESOPs are given to employees what at a discount rate. And ESOP issued to employees are to be held for a lock-in period after they are given. But for some directors, correct, it may not be the case, right? So you have advantages, disadvantages. ESOP gives what ownership into the company, so makes employee feel that he's owner of the company, right? Company can raise finance through ESOP issue, correct? Company will get money. Disadvantage is there is no relation between amount of work. You may work as much as you want, but will the share price increase because of you? No. Share price may go underwater, correct? After ESOP issue, it happens so many times. Director or manager can sell their shares immediately and earn cash profits after ESOP issue, but employee has to hold it for certain period of time. There will be a dilution of control in the shareholding of the company, as employer what own a certain percentage of shares. And then come to this part of here, if I'm not wrong, come back to these notes, LDR notes. I'll give you the theory notes, don't worry. Corporate governance, where you have 5 or 6.51% or more INDs should be independent, correct? And there should be INDs, that is independent non-executive director, should be on the board of directors. MD of the company and chairman of the company, chairman of the meeting should not be the same person. Audit committee and nomination committee, correct, should consist of INDs only. INDs will be paid sitting fees for attending board meetings. INDs are not employees and are not paid salaries. What? Directors cannot be lifetime directors. He should what? Every 3 years propose a reappointment. These are the points that are there for corporate governance. I think value for money, VFM concept I taken here. Value for money 3 is economy, efficiency, effectiveness. Economy relates to inputs, efficiency relates to process, output, effectively how effectively you fulfill your objectives, correct? That is what? Your effectiveness, correct? And that is how 3 E's work out, correct? Always, sir, great inputs, economy, correct? Economical inputs. Great processes, efficient processes. Sir, objectives fulfilled, effectiveness. Right? Questions of these sort come up in. Then after this, I think FM environment chapter is there. Here I have chapter 2 chapters. First, let's do chapter 7, FM environment. Macroeconomic target of government, correct? You have fiscal policies, those are contractionary and expansionary fiscal policies. I bet one question comes on, 1 or 2 MCQs come from this chapter. 2 to 4 marks, but very simple 2 to 4 marks. You will not have any problem at all, right? So macroeconomic target of economy are very simple. Want to have stable economic growth. You want to have an appropriate distribution of income between all the citizens. Then you need to have full employment of resources. You need to control inflation and maintain stability of prices. Surplus budget and balance of payment should always be positive. Correct? What is balance of payment? Nothing but whatever you pay for imports against whatever you receive for exports. Then you have certain what? Tell me. Fiscal policy and monetary policy. Fiscal policy is related to government spending, government borrowing, and taxation. Monetary policy to money supply and interest rate. Okay? So fiscal policy, whenever I say contractionary fiscal policy, that means you want to what? Contract, or you want to make the economy very small, right? Then in that case, what will happen? Tell me. Government spending should be reduced, government borrowing should be reduced, taxation should be increased, so people don't have money, right? They cannot do a lot of spending. Inflation, correct? Inflation should be kept down because then prices will not be kept up, correct? No one will be ready to spend that much. Demand will always be low, purchasing power will also be low. When there is an expansionary fiscal policy measures, the government spending will be high, government will open up new hospitals, government borrowings, it will borrow more and more from different sources. Taxation will be reduced, people will be earn more money in their hands, correct? Inflation will go up, but in a healthy state. Demand will also go up and purchasing power will also go up, right? Then coming to problems with the fiscal policy, right? The crowding out, people shift their investment from equity market to government securities as government will better, right? So happens crowding out, right? In fiscal policy, government will give best return because they want to borrow more and more, correct? So risky security return more than government security, it is called as a positive yield gap. If risky security return is less than government security return, it is called as negative yield gap, correct? And then you have risk-free, risky security. Okay. This is nothing but crowding out. People switching from what? Government securities to equity market, or from equity market to actually the problem is from equity market people turn to government. This happens generally. Negative yield gap is not a very good thing. It happens generally in the time of war when money or government needs a lot of money. Correct. Monetary policy, contractionary monetary policy and expansionary monetary policy. Your money supply, if you want to get the economy what contracted or smaller, then money supply will go down, interest rate will go up, no one will be able to borrow easily, correct? Reserve ratio of central bank will be high, banks liquidity will also be taken up, borrowing will be low, right? Then ms, that is money supply is low, investment will be low, demand for goods will be low, correct? Or demand for bonds will be low, price of the bonds will be low. Money supply is low, your production will be low, export will be low, balance of payment will be negative, investment in production will also be. Government sells securities and takes some extra cash from market. Money supply will be curbed by the government. But if government wants to increase the money supply, then reserve ratio of central bank will come down. So more money for bank for borrowing. Money supply, if it wants to go up, investment will also go up. Demand for bonds will go up because more people have more money. If more demand for bonds, more prices will be higher, right? Money supply is higher, the production will be higher, export will be higher. Export is higher, BOP, that is balance of payment, will also be positive, and investment in production will also be higher. Government bonds or government buy securities and pay to market, right? To market what? Money supply is higher. Government wants to buy all the securities from the market. It will give the market money. Correct? I've explained all this. Then there is something called as monopoly, single player, right? Who's a price maker. That is their duopoly, two players who can decide to price. Right now, Airtel and Jio, correct? Then you have oligopoly, UAE, right? The cartel, right? Oligopoly is what? A cartel of people or cartel of sellers trying to what? Make the price. Or there is a perfect market, right? Everyone is a price taker, correct? Sources of finance, right? Chapter 8, very important. One section C theory question comes up from this as well. Criteria for choosing source of finance. Most important question, LDR question in your exam. LDR question. Criteria for choosing a source of finance. 6-7 criteria are there. Security. First is actually cost. Cost. Debt is cheaper than equity. Equity is expensive. Whenever you go first, even your pecking order theory says the same. First look for return earnings, then debt, and then equity. Correct? So debt risk is lower, equity risk is higher. Debt interest is compulsory. Equity dividend is not compulsory. Correct? Debt gets what? Tax ka shield. Equity does not get tax ka shield. So accordingly you decide. Correct? This is the criteria you have to look at. Matching duration. If it is a short-term finance, correct, it will be generally cheaper. Long-term finance, it will be expensive. Short-term finance generally is less risky, correct. Long-term finance is generally more risky. Short-term assets should be funded by short-term finances. Long-term assets should be funded by long-term finances. Term structure of interest rate says what? Tell me. Always, when you buy for a or borrow for a longer term, you will have a higher rate of interest, correct? Long term, more interest, short term, comparatively lower interest, correct? The yield curve is sloping upward, correct? In gearing, if there is a very high gearing, then risk is very high. Raise equity. If there is low gearing, risk is low, and you want to increase value of company, raise debt. Accessibility. Big companies have what? I told you, sophisticated companies have access to a lot of different kind of what? Tell me. Finances. But everyone might not have access to those kind of finances. Securities, without security, it is difficult to get long-term loans, correct? So with security, a long-term loan is easier to acquire. Then you have nothing but the short-term wala, gearing wala part. I will look gearing as a debt equity ratio. That is what? 90 is to 10 equity is to debt, right? Or 10 is to 90 equity or debt is to equity. That is what debt is to equity ratio. When gearing given as a percentage, it will be what long-term debt divided by total capital. It is long-term debt plus equity plus reserves, right? Then you have market value of debt if it is on market value basis, correct? When it comes, there is a lot of confusion about sir market value of whenever market value rate is given, should we include reserves? Tell me, or should we not include reserves? This is a very big question. Tell me. Whenever doing it on book value, equity may always include reserves. Whenever you're doing on market value, reserves is already included. So you don't need to add reserves again. Market value of equity share already has the reserves. If you want, the question मैंने यहाँ पे किया है, additional question for you to understand. The preference shares for FR purposes or general purposes will be what part of equity, right? But when it comes to gearing purposes, preference share will be what? Debt or equity? Tell me. It will be debt or equity? Bolo, bolo.
Debt.
Debt. Preference share will be debt when for gearing purposes, correct? So if long-term debt like bank loan doesn't have market value than book value is equal to market value. High gearing means more debt. It means more interest payment, means risk is higher. Low gearing means less debt, less interest payment, risk is low. Next. Then coming to the part of short-term source of finance, you have OD and short-term loans. Then you have operating lease, financing lease, and sale and lease back. Correct. So overdraft, cash credit limit is given, right? You don't have to pay interest only on the utilization of the limit amount. Short-term loans, full amount needed in business, correct, or received in business. Interest on full amount to be paid. Operating lease is what? Tell me normal lease that you do, correct? That is a source of finance. Operating and finance lease both are what? Operating is what for operating of what? This is not a purchase or anything, but finance lease, instead of purchasing, you take a finance lease. So over the years, you pay the lease, and at the end, you are given an option to buy the asset. Correct? That is a financing lease. Sale and lease back means what? Now see, you have a very big asset. You have a asset which is there, right? And your borrowing capacity is very low. Correct? No one is giving you loan, but you need money for what? Some expansion. So what do? You sell that asset to the bank. Correct? And lease it back from the bank. So from by selling it, correct, you get a big amount, correct? And slowly in lease, you pay the amount back to the bank, correct? Then in long term, you have equity, preference share, and debt. Equity share may they provide ownership or voting rights in the company, correct? They are generally what unsecured investment for inventory, and they have the last preference in the case of what? Tell me, liquidation. Equity ko last paisa milega, correct? Dividend is not compulsory to be paid every year, correct? Generally, they are more risky investments and will have higher return, correct? Then no tax savings or anything on equity, correct? Return on equity formula we have done, PS formula we have done, DPS formula we have done. I just told the students to reiterate the formula, correct? Then sources of equity capital are what? Three sources. First source or first, if I want small amount of money, I will go to retail earnings, right? Cheapest or no cost at all, right? Because it is what in my pocket always. Right issue of shares, correct? Less cost compared to normal issue, right? Right issue of shares, right? Less cost. And then normal issue of shares, it is IPO or FPO. Preference third, most costly option. Correct. When you have to raise very big amount, go to IPO, FPO. Minimum amount, go to right issue. That is existing shareholder asks for money. Correct. And coming to right issue of shares, you have the formulas of right issue of shares. Tell me, you have what? Theoretical X right price. What is theoretical X right price? Tell me TERP. What is the formula? Tell me what is the TERP formula? Existing number of shares into existing market value plus right shares into right share price. The whole divided by existing shares plus what? Right share issue. Correct. That gives you TERP. Then what is value of right per existing shareholder? Tell me. Value of existing. Value of right per existing shareholder. Have a look. Theoretical X right price. Have a look. Are you okay? And value of right per existing share. How do you calculate? Tell me. देखो है क्या formula?
TERP minus right issue price.
TRP minus what? Tell me.
Right
Right
issue price.
issue price. Correct. That is value of right per right share. बराबर है क्या? Value
Yes.
of right per existing share क्या है? Existing market value. The see loss of existing shareholder and profit. See loss of existing shareholder is value of right per existing shares, and profit of the right shares, right, is nothing but value of right per right share. So TERP minus right issue price is your what? Tell me. Value of right per right share. Correct. Value of right per existing share. The existing market value minus TERP. Correct. 1.9 and here it is 7.6. These are things. Even tell me your wealth of shareholder was also a question. Wealth of shareholder. Tell me wealth of shareholder. If you buy the right shares or sell the right shares, correct? Will the what? Tell me. Wealth of shareholder change? No. But if you do nothing, will you lose wealth? Yes. I think I must have done one question here of right shares. Have a look here. Table भी बनाया होगा at the end. When you do nothing, tell me, there will be fall in wealth. Before right issue, there is fall in wealth. But whenever you do what? Tell me. Whenever you, there is no change in wealth if you exercise your option of buying the right, or if you sell the rights also, There will be no change in wealth. So remember that one MCQ comes up, that if you end up doing nothing, right, in that case, what will happen? Then there is something called as issue of shares to new shareholders, correct? This has come up as a theory question, correct? Placing means what? You place the shares 20-30% to bankers or to prospective investors, correct? Or you do public offer, correct? In public offer, what happens? Tell me. Fixed price offer, or it could be what? Tell me. Uh, Quotation price offer, correct? So fixed price offer may you provide the price to the shareholder. Where you don't know the share price, there you give what? Quotation price. So everyone quotes the share price. All the prices are taken. What average price is chosen, correct? And everyone is done the allocation. Then there is offer for sale, right? A chunk of shares are sold to the investment bankers, correct? Right? And then there is IPO or FPO, right? You do a what? Tell me. Initial public offer or a final or follow-up public offer, right? Preference shareholder, ownership is not given, voting rights are not given, preference over ordinary shareholder in listed shareholder. But they are what? Dividend in preference to the equity shareholders. Even while repayment of what? Tell me, capital over equity, they have what? Preference, correct? For gearing or COC purpose, preference share is debt, correct? No tax impact because it is paid after tax is paid. Then coming to long-term debt, we've already done this redeemable, irredeemable, convertible, bank loan and loan note with share warrant. Only we are to do loan note with share warrant. So what do you do? A loan note is given. With that, a share warrant is added. Share warrant gives you what? Right to buy the shares at lower cost, correct? So those are there. Then you have advantage and disadvantage. Had come up in exam once. You don't know. It can still come up in exam. So advantage what it is cheaper, has predictable cash flows. You know how much interest to be paid. No dilution of control because of this, what will happen? Your equity shareholding will remain the same. Disadvantage it is inflexible. Every time you have to pay the interest, correct? High gearing is high risk for company. And obviously it should be paid off. Equity need not be paid off. Right? You have venture capitalists generally invest in what? High growth business ideas, right? Which have very high risk and they expect very high return. Invest in business which are new and profitable, right? Invest based on what? Management ka potential, limited history that they have, and previous profitability history is not known. And there is something called as equity racket. What is equity racket? First, the venture capitalist will give you certain money and say that the target is getting XYZ amount of profit or XYZ amount of percentage of return. If you don't fulfill that, what he will do? Tell me. He will directly what? Tell me. Some problem ही करेगा वो. He will say that if you don't fulfill the target, you will get free 10% equity in your company. Like that, he will slowly take over your company. There is finance for SMEs. You have funding gap and maturity gap. Maturity gap means what? You have short-term loan, you have long-term loan, but you don't have medium-term loan. That is maturity gap. When it comes to funding gap, right? Everyone has in this world has funding gap. It can be fulfilled by bank, venture capitalist. Business angels are nothing but smaller what? Investors, right? Angel investors type, correct? These are up to 100,000, more than 100,000 generally venture capitalists do investment, correct? Then supply chain finance is what? There is a main, what? Tell me. There is a supplier, and then there is a main customer, and then there is a bank. A supplier is a smaller supplier. There is a main customer who's a very big customer, Tata or something of that sort. So the main customer gives a very big order to the supplier. Now the supplier does not have money to fund this. So he goes to the bank and says that boss, aisa order is there, right? So I need finance. So bank says okay. It takes a confirmation from the main what customer and says okay, gives the extra finance and gets the job done. This is supply chain financing. Crowdfunding is you ask that I have this business, correct, and I urge everyone to invest in my business, right? I will give you XYZ amount of return, and via internet and other sources, you start getting money. Peer-to-peer lending is nothing but the 12% club kind of investment, right? Where you invest your money on some platform, correct? Or you list that you have XYZ amount of money with you, right? People who need money will also come on that platform, right? So people who have money and people who need money are both on the same platform. So people who have money will give it to the people who need money and they will pay you returns more than the bank. correct? So that is peer-to-peer lending, right? And then I think last would be chapter 15, if no, Islamic finance, right? Islamic finance is what? Interest payment are not allowed in what? Islamic finance, correct? Three things. You would rather receive profit share from investment in business, and Islamic finance cannot be used for prohibited businesses, gambling, alcohol, etc. Then you have Islamic finance sources. Very important question. Has come up. I cannot even tell you how many times this has come up in the exam, right? So it is Murabaha, Mudaraba, Musharaka, Ijara, and Sukuk. Murabaha is what? Tell me. Trade credit and loans. Well, पहले ijara I would have done. Ijara means what? Lessee and lessor, correct? Responsibility of keeping the asset in good shape, and owner of the asset, maintenance of the asset, depreciation or scrap value will be there, and at the end of the asset or at the end of lease, lessee is given an option to buy the asset. So it is mix of operating lease and option at the end. Sukuk is Islamic bond. Islamic bond is very interesting. Why is it interesting? Tell me. Normally, traditional bonds is what? Company raises funds against the asset. Company is the owner of the asset. The loan note holders will receive interest, correct? Right? And it is kept as a security that is there. If something happened, the loan note holder can sell the asset, right? Obviously, company through the company they can sell the asset and get the money. But when it comes to sukuk, right? Company, if for an asset, if it does what? Borrowing, the sukuk holders are owners of the asset and they will take all major decisions regarding the asset, correct? Whatever through the business profit or loss comes, that will be paid to the sukuk holders, not any interest, because interest is what? Prohibited in Islam, right? Then you have Murabaha trade credit, correct? Two things. One is trade limit or trade credit of 30-60 days, correct? And what? The loan system. Traditional loan is what? Tell me. Mr. A buys an asset, bank gives loan, correct? And the asset is owned by Mr. A, correct? And then Mr. A pays EMI every year. But when it is Murabaha, correct? What happens? Tell me. Mr. A will not buy the asset. The asset will be bought by bank at 10 million. Bank will add what? Tell me. 2 million of interest component or profit component as they call it, correct? And sell it for $12 million to Mr. A, right? And receive this money in 10 or 12 installments, depending on how the work happens, correct? So this is Murabaha. You have nothing but the Mudaraba. Mudaraba is what? Tell me. One person coming in with the money, the other person coming in with the skill. If there is a profit, it will be shared in PSR or it will be shared between Rabul Mal and Mudarib, correct? But if there is a loss, only Rabul Mal or Mr. A who bought the money will own the loss, right? He will cry, oh Rabba, I have lost my money. Sorry, but this is how you remember it. Sharaka. What happens? Mr. A with money and skill, Mr. B with money and skill come together, do a business. If there is a profit, they share it in PSR. If there are losses, they share it. Correct? With this, एक मिनट, chapter 15 नहीं था ना इसमें? Tell me. Financial market वाला. Tell me. Was it there?
No, sir. Treasury functions and ratios is left.
Just a second.
Hmm.
Chapter that is your FM environment is done. FM markets is remaining, right?
Yes, sir.
Monetary not done, no? Here, chapter financial systems. Raja, financial markets, right? Basics, financial intermediary and their advantage, correct? Types of market that are there: capital market, money market. Then you have euro currency market, euro bond, and foreign stocks. Then treasury functions, correct? So you have what? Have a look. Basic financial system has three what? Tell me, participants. Or
Luxury
three:
market, institutional securities.
financial institution and financial security, right? Financial market is your stock market, capital market, money market, and all those things. Financial institutions are investment banks or domestic and international banks. Financial securities are equity shares, whatever through which you trade, correct? Then a financial intermediary, you have what? Tell me benefits of financial intermediary. What are the benefits? Maturity transformation, right? Maturity transformation means what? A financial intermediary will take small deposits and convert it into big loans, right? That is what maturity, or short-term deposits will be converted into long-term loans. Have a look. Maturity transformation. Aggregation of funds. It will take small deposit of $1,000 and make it in a big loan of 10,000 or $50,000. Have a look. Small value deposits, right, aggregated into large borrowings. Pooling of losses. See, if intermediary was not there, Mr. A would directly invest in Mr. B's business, correct? And if Mr. B's business would go for a loss, correct? All the money of Mr. A would go for a loss. But here, Mr. A, B, C, D, E, F, G are all depositing, right? At one place with the bank. Bank is borrowing to 10 different people, correct? And what happens? This whole money is divided into small parts and given to these people. Even if one of the business what fails, no tension. Risk of individual depositor is reduced by pooling the deposits and lending out various amount to various borrowers. Disintermediation. That means you remove the bank, correct? So traditional system of depositing and borrowing through bank is out of fashion. Thus now depositors directly invest into various companies through the stock market. Right? Abhi, now depositing, we all do what? Investing in stock market. Right now, not a very good thing, correct? But if you are going to start your investment journey, right? Maybe the correction or the dip is the way to start, correct? Types of market, you have primary market and a secondary market. Where primarily shares are sold for the first time by company to the investors, it is called as primary market. Secondary market means what? When first investor resell or repurchases shares from open market, it is called as a secondary market. Then you have nothing but the financial market is a money market and capital market, correct? In money market, you have interest bearing securities and discount bearing securities, right? You have money market deposit between banks for a short term, and it is a non-negotiable instrument, not negotiable, correct? But when it comes to CDs or certificate of deposit between investor and banks, correct? Those are negotiable instruments, correct? Certificate of deposit, normal FD, correct? Then repurchase agreements where you sell certain shares now because you need the money and repurchase on a later date, correct? A repos, right? Those are non-negotiable instruments. Treasury bills, government-backed securities, right? Generally issued by governments, and US treasury bills are very famous and have a lot of value all over the world. And these are negotiable instruments. Commercial paper, also a way by which big companies can raise what large amount of unsecured money for a short period of time, correct? Commercial paper, it is a negotiable instrument. That means it can be sold from one person to another person. Acceptance credit, bill discounting or commercial bill of exchange, IOU, correct? Acceptance credit and bill discounted and all those are non-negotiable, but bill of exchange, IOU contracts, correct, are what? Negotiable. When risk ranking is to be done, right, the least risky is your treasury bill. More risky than that is certificate of deposit. More risky than that is commercial paper, and most risky is bill of exchange and acceptance. Right? Lot of questions. I cannot even tell you how many questions you must have seen about this in the exam. Which are negotiable, which are non-negotiable, which is less risky, which is more risky, correct? Then you have euro bonds, correct? Euro bonds are what? Tell me. Is it bond denominated in euro? No. It is a bond that is denominated in different currency than your home currency. It is a bond that is issued in the currency other than the home currency. An Indian company doing a dollar bond issue is also called what? A euro bond issue, correct? So euro bonds are called external bonds and will be issued in international financial bond, correct? Take a minute. Then euro currency loan means what? Loan taken in foreign currency by local business. Indian company borrowing dollar through international banks, right? Then treasury function. Core function of treasury department, three things: cash and liquidity management, corporate finance, and risk management, right? Cash and liquidity में working capital, day-to-day working capital, right? Cash forecasting business or cash forecasting activity, correct? Budgeting activity. Corporate finance means raising money, doing investment appraisal and raising money from best sources of finance. Risk management means your forex as well as interest rate risk management, right? Then you have types of treasury function. You have a centralized treasury function and a decentralized treasury function, correct? You have an advantage and disadvantage of each one of them. Generally, advantage of centralized treasury is what? You can borrow at a lower rate, right? Foreign exposure can be managed efficiently. Economies of scale will be there, right? Borrowing by holding company will be at a lower rate, correct? Higher amount at lower rate. Reduction of borrowing due to cash surplus. See what will happen if it is centrally managed. One company has surplus, one company has loss, correct? So what can happen? This company can help this company. It does not need to borrow, correct? So here there is surplus, here borrowing is required. So this person can give money instead of this person going and borrowing it, right? Availability of experts in central team, because experts cannot be made available in each and every country, decentralized, correct? Lower precautionary cash balance can be held when there is a group together, right? No need to hold a, see, individually when you have to do decentralized, correct? In that case, what you'll have to do, each branch or each company will have to have their own what minimum balance, correct? Disadvantage, less autonomy. Indian person knows what happens in India. Someone from USA cannot tell what to be done in India, correct? Delayed response to local economic conditions, correct? And centralized team has less information about local conditions. But when it comes to decentralized, what are the advantage? Local asset and liabilities are managed in a better way, obviously, because you are in this country and you will be able to do that. Greater autonomy to local subsidiaries. Greater autonomy to what? Local subsidiaries. Better and quick response to change in local economic condition. Better and what? Quick response to local. That cannot happen in centralized function. Disadvantage is what? Higher rate of borrowing in local market, right? No expert team available in local market. Foreign exposure cannot be managed efficiently, and higher precautionary cash is kept individually. Advantage, disadvantage. Read once. Important question from exam point of view. LDR can appear as a theory question in exam. I think sources of capital. Now we are done with this. I think anything left? Whole portion revised under 8 hours.
Yes, sir. I think everything is done.
More than enough. Now what you can do? Logically, I had to solve. Now you have good 3 days remaining or 2 days remaining. No, Wednesday, Thursday. आज का half day, right? So solve all your questions, correct? A to Z, everything, right? Go through each and every MCQ. Go through each and every section C question ka adjustment, right? If you have any doubts, you know how to contact me. Okay, right? All the best for your exam. Take
Thank
care.
you, sir.
Bye bye.
Bye bye, sir.
Thank you, sir. Will you add something? Tell me.
Yes, sir.
Okay then, guys. Bye bye. We'll meet now. I think next quarter, whatever batch if you take, right? We'll meet at that time. Okay. Chalo. Bye bye.
Bye bye, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir. Bye bye.
Bye bye.